Welcome to August. It's Trade Live with IG and it's Friday. Non-farm Friday, Ronnie.
Non-farm Friday, but it's a great Friday because we get to start it together, Rich.
I don't think we've done a Friday before together, have we? It's normally Minnie Cooper's slot, sometimes Pete Ward's.
The graveyard slot.
How come you got it this week?
Well, I was just a lucky guy. I was requesting to be with you. I said, I haven't been with Rich all week. I need to get my time in.
So you've been on late shift all week, have you?
Exactly, yeah.
Good morning to you all, Friar Tuck. Our hearts go out to you. It's Sydney's coldest July day in decades. Oh, what a shame to live in paradise.
Yeah.
With spring on the way.
I'm suffering with you, my friend. As a Swede, I can really relate to that.
What do we think cold is in Sydney?
Isn't it
10
like
degrees?
Maybe probably like 20.
Yeah, yeah. There we are. That is our beautiful view from the back of the studio this morning. Can you just see St. Paul's over there? Isn't it? It's looking good this morning, isn't it?
It's looking absolutely brilliant. Is that Blackfriars 1? Is it Blackfriars 1 or 1 Blackfriars? 1 Blackfriars. Got St. Paul's. You know they charge you to go in there.
They charge you. It's not your kind of place, pal.
Listen, I'm not gonna say what I think. We'll take that off screen.
Right, let's look at what's coming up on today's show. It's not the droids you're looking for. Right, we've got overnight action coming up 7:40. That's an interesting one. We've got Ronnie and Martin Harris bringing you the week ahead. Is it going to be as exciting as the week we've just had? Which is still not finished yet. We've got my good friend from also Panmure Liberum, Mr. Clement, coming in at 8:35, and that is live. That's not recorded. So, considering we just saw the market roll over.
Is he still on the phone? Is he still on the phone at Panmure? We ever get through to him?
Oh no, he's coming in.
Yeah, but now, is he still on the phone? Does he work the phones at Panmure?
I would imagine he does have a phone. I don't know. What's your point?
Move on. All sessions opening bell, 9 a.m. with Rich McDonald. When he lacks in knowledge, he makes up in charm. And then moving on to Expert Edge, so we can get someone who knows what they're talking about. And that is Bill Blaine, who's going to come in.
What a double header. We get Joe and we get Bill in the same day. I feel by 10 a.m. today, I am going to be a lot more wise.
It's going to feel like you had a Glaswegian kiss, my friend.
To you, Jimmy. Right, before we find out how Ronnie's love life is going, what is the update? One of these days I'm going to ask and he's going to start crying, isn't he? Let's go into overnight action. That's right. So before we go any further, we've got to talk about this market rolling. We said yesterday, my 5 apostles that I trust very much all said to me within a few days, this is at the high. This price action is topping out. And oh boy, did we see it roll yesterday, right from the S&P open at 230, which is around about here. That was the writing was on the cards. 6,411. We are now trading 90 points lower on the S&P. Why, I hear you ask? Because we traveled and we arrived.
Indeed.
What did you see yesterday on the desk, Ronnie?
Yesterday on the desk, it was sort of like we had quite a lot of clients who called in around that time period and said, well, we started the day brilliantly. What happened? And then we were all sort of like scrambling to figure out, well, what actually had gone on. But we couldn't. He was specifically asking for some certain stocks, but we couldn't see why the overall market in general was downward trending because there was no news out rather than the rollover.
Every last buyer was in that market. They had all bought, and everybody scratches their head and says, "Why is it going? The markets don't go down, do they? Why is the market going down on good news?"
Yeah, that was exactly the conversation we had.
I don't understand.
I was scooching over to the Bloomberg terminal trying to find any news that was going on, anything that would shake it, but nothing that could really move the market.
And look at it on that chart. You can hardly even see it. That little,
It's a little blip.
a little blip at the end.
But hasn't that been sort of, Richard, hasn't that sort of been the theme in the market, sort of the market discussion these past, say, month or so, where everyone's just scratching their head saying, why is the market continuing to go up? And now we're saying, well, why has it gone down? It was just always going up.
Yeah. So that was a beautiful thing yesterday, but let's get you through the important numbers from last night. So Apple reported numbers about 9:30 p.m. last night. Those were pretty impressive. The strongest revenue beat since December 2021. So a good beat on revenues. Those came in at 94 billion versus expectations of 89.5 billion. That was a 10% increase year on year. EPS 157 against 143 expected. A really strong beat on the EPS line. You had iPhone revenues. That was actually one of the big drivers. So iPhone revenues, where people were concerned, those came through a little bit. Tim Cook admitted benefited from pull forward of demand ahead of the tariffs coming in.
And also, sorry to interrupt, but there's also a Chinese stimulus to buy smartphones, which is also one of the reasons. So there's sort of Chinese benefits that you get, sort of contributions when you buy a smartphone. So, and that's also why the Chinese revenues grew by 4%, which was one of the big China, which was one of the big catalysts in the stock itself.
That's right. So China revenues up 4%. China, I'll do it again so we can cut it for social media.
China.
Okay, we get the point, guys.
China sales up 4% to $15 billion. That was an important number. That allowed the stock to go up 2.5% after market. Let's see what goes through today, because Tim Cook warning there is a 1 billion hit coming in costs from tariffs in the next quarter.
Tariff, love the tariffs.
I mean,
this quarter was 800 billion. That's actually down from what he warned of 900 billion. But next quarter, he is guiding towards a $1 billion hit there from tariffs. Right, now you can play your things, because we've played it for social media.
Rich, is
because they managed to mess it up yesterday and they didn't even get anything out.
Is a $1 billion hit really that substantial for a company that does 94 billion a quarter?
Yeah, but that's revenues against cost, remember. So it's not against 94, it's against the profit line that you take.
They're still an incredibly profitable company. I mean, it's not going to make a dent, really.
Well, it does, because it just hit his margin guidance. So he had to come out and say margins are only going to be 46 to 47%. Lower than expected because of tariffs.
I'll tell you what's going to hit its margin guidance is that Epic Games have won their appeal against Google in the Google Play Store, which will set the precedent for other actors and companies to further go in against the Apple Store rules, terms and conditions. Now that's something that's going to hit their margins. But as Rich was kind enough to walk us through Tim Apple's company, we are going to walk through Amazon.
Are you going to try and do this, are you? You got to get it right in one shot. Right, let's go. 3, 2, 1, and action.
Amazon reported Q2 2025 revenue of 167.7 billion, up 12% year on year. Operating income is 19.2 billion, up 31%, and a strong free cash flow. AWS revenue grew 17.5% to 30.9 billion, with 195 billion backlog and ongoing supply constraints. Q3 guidance with revenues of 174 to 179.5 billion, with operating income up to 15.5 to 20.5 billion for the upcoming quarters. Thank you.
That's going to be a hit on TikTok. That
was for my mom and my girlfriend.
Let's get a TikTok out of Ronnie looking at his computer screen, reading out numbers.
You were looking at them as well. I was just making sure that I give our readers at home accurate information. But before the slander going out, I just want to thank my mom, my girlfriend, for that performance. And then we're also moving on. But
girlfriend? It's official.
It's official.
Whoa! Well done, Ronnie. Down on one knee?
No.
She wasn't? So that is impressive. Ronnie has made the commitment.
Yes, I just felt like it's Friday. I give the people what they want. I know you've been dying to find out, but before we move on and from my personal love life, we do have a question. The people have a question to you, Rich. From my brilliant speech here of the Amazon report, sounds pretty good, right? Yet the stock was down 6.5%.
Right. Should we do it properly now for social media? So an Amazon beat on the top and bottom line, but it failed to deliver for investors. The problem being, we have to cut that bit.
Ron Burgundy over here.
Ready? The problem being weak operating income guidance for the next quarter. So remember, investors always looking forward. That had the stock down 5% after hours and also took the S&P down a further 12 points. Now that the big four have reported, today, Ronnie, we're moving on to non-farm payrolls. It's got to be something impressive to keep this market. Otherwise, all the confidence could evaporate.
We have some pretty big reports coming in today as well. So we have both economic data and some big companies coming in today. What are you looking out for this today in terms of earnings?
Well, I'll tell you what, we'll keep the preview of the non-farms for quarter past. Oh no, because you're on with Martin then, aren't you?
I am.
Right, let's do it now then. Let's do it now because you're going to do the week ahead for next week. So let's do the non-farm payrolls and the expectation now. Here is the preview that you need for today, NFP. So the consensus is 104,000 jobs versus prior of 147,000. That would take the 3-month average lower because that's been at 150,000 jobs. Fred's bargain break even is between 80 and 100,000 jobs to be added. However, that is below the whisper number. The whisper number is around 120,000 jobs. Unemployment expected to come in at 4.2%. That's a slight increase from last month's 4.1%. But remember, the Fed already has it in its predictions that you could see unemployment up as high as 4.5% by the end of the year. However, Ronnie, I hear you ask, what do we think the reaction would be? Well, JP Morgan give us a beautiful guide here. They say if the jobs number comes in above 144,000, the market's going to take that well. The market is going to be excited by the strength of the the strength of the US economy. On the low side, if we're below that 100,000, JP Morgan think that's taken negatively down as much as 75 basis points. And if we get a really weak number, Ronnie, below 80,000 jobs added, the S&P down 2%.
I mean,
I think that's really
I disagree. Obviously, these highly educated JP Morgan economists, they're not as, as you and me.
Market savvy.
Exactly, yeah. Otherwise, they'll be here trading on the demo like you and me. But my question
is... You just try and tarnish me with a demo account. Do you think I would have these wrinkles if I was trading on a demo account?
Yeah, that's true, mate. You're the best looking 60-year-old guy I've ever met.
No, that's our friends Poppy and Spice that do our top #1 IG podcast now.
Oh, interesting. Can't wait to have a listen. But Rich, forgive me if I'm simplifying things here, but wouldn't weak earnings reports and weak job numbers, wouldn't that be something that would support the case for cutting the rates?
Well, this is the problem that they're in now. Okay, they kind of backed themselves into a corner. Powell's focused very much on inflation and the problems of inflation from tariffs. So if you see a weak jobs number, but a high wage growth number come in today, then that would be carnage. Then the market can be down 2%.
Absolutely. Well, then it's sort of a perfect storm for horrible market conditions.
Yeah. But I mean, with vol being where it is, I see the most likely move down 60 basis points. 80 basis points, maybe.
So not even a percent.
No, well done. Hey.
Yeah, but we throw around these numbers, 60 basis points. It's 0.6%, guys. It won't move the needle.
Well, it does, but it adds to Martin's point. There is that an island reversal on the S&P. You know, with a further dent to confidence, another 80 basis points takes us down to 6,250. Then suddenly the momentum's gone, well and truly, and you've had all your big positives. Let's not forget the numbers that have been terrible this week. Yeah. UPS got absolutely smashed to pieces. United Health got hit. Novo's got hit. There are a lot of numbers coming through below these tier 1 Mag 7.
Yeah, but I think absolutely. I think, but out of those that you mentioned, sort of United Health, they've sort of in a criminal probe, criminal and civil case with DOJ. So that's hitting them as well. They've had issues going longer than that. But also, I think the one company out of those who actually can serve and give guidance to a bigger macroeconomic perspective and sort of the consumer spend is UPS, because it has a direct correlation with consumer spend. Yeah. But I think it's about time we get a bit of like a market pullback. Not that I want it, but I do think it's more than likely that we're gonna get it. And it feels like also the Trump administration sort of sneaked in all these tariffs that they put in place. So 20% on Taiwan, 39% on
consequences haven't even begun yet.
No, that's what I mean. We haven't even seen them, but we've had this sort of taco Trump where they flip-flop back and forth. It's gonna say, oh, now it's a delay, it's a pause, 90 days, etc. But sort of underneath all of this, yesterday it came out with 20% tariffs on Taiwan,
so let's
39 on Switzerland,
perfect,
19% on Cambodia. They said, Thailand, Cambodia, you guys need to stop going to war and find a united enemy in us. Here's 19% tariffs.
Right, so the new tariff rates against some of the US biggest trading partners, there they are, takes you down the April 2nd, but also those new rates that have come out. However, there is another graphic somewhere here that takes you through them all. So here are the tariffs rate. Run us through it.
Syria. I thought Trump wanted to remove restrictions and he wanted to remove everything on Syria so they can start their country fresh again with their new good-looking leader. Was that how he described them?
Oh, no, I didn't. I missed that.
He's a very tall, handsome guy.
Yeah. But the important ones overnight there that have been added to that list are the two on places 5 and 6. Switzerland hit with a 39% tariff overnight on their national holiday. Nice timing. And then Canada, 35%. Mark Carney not particularly pleased with that, but he says talks are still ongoing. So yeah, a whole new August the 1st range of tariffs there. They will come into play in 7 days' time. Will they really?
No.
Will they really?
I mean, calling him the boy who cried wolf is not even doing
it's not fair to the wolf.
Exactly, it's not fair anymore because he's just going back and forth, back and forth. He's going to do this for 4 more years.
4 more years. So yeah, that's our tariff news overnight. What else? We've got the front page of the Financial Times. Let's look at that now. Oh, producer Phil, the Financial Times subscription runs out today. Do you think, that's the poll of the day, do you think producer Phil will find £40 a month to renew our FT subscription?
I don't know. I asked Tom Roberts when I was new on the desk for a FT subscription, and he's like, yeah, we'll sort it out. Still don't have it.
Yeah, but I don't know if you've noticed, we actually show this to the viewers. Well, it's fine. We can show the City AM website.
I always get the physical copy. I can bring it in for you guys next time.
I'll just hold it up.
And you can go up to the screen and hold it up.
Perfect. It'll save us 40 quid a month. Ideal. Right, so Trump reignites global trade war with sweeping tariff regime is your front page. And then we've got, of course, the numbers from Apple and Amazon. But Ronnie's done such a good job of reading those out.
I can read.
That I'd say we've done that one. And yeah, a few sort of opinion pieces there. Goldman Sachs poised to buy into ice cream.
Häagen-Dazs.
Häagen-Dazs. And then here's the one you were talking about. It's Figma. So take us through what happened with Figma yesterday.
Yeah. So Figma, for those of you who don't know, rich, not really tech savvy, not really with the times.
Fact.
So I'd be happy. Maybe I should look at you when I explain this. But yeah, so they are basically Adobe on steroids. It's a much better sort of software program where you do sort of editing. You can do product mock-ups. Sort of our product team, they all use Figma. Our marketing team, they use Figma. So it's something that sort of it's a tool to use for designers, for programmers to sort of build mock-ups. It has a great AI integration, and it's a brilliant company that's being used by over half of the Fortune 500 companies, just to mention a few. They've done really good, and then now this year has been leading up to their IPO at a $1.2 billion valuation, which is supposed to be sort of the hottest software startup that was going to come in now. So they were $1.2 billion valuation, coming in at $33.
Right.
We had quite a few clients who called in, trying to get in, place a limit working order there at 33. Don't be a for a tick, is that the saying goes. I'm not going to say it. Anyhow, so there was pricing at 33. They were up 250% on the day. So safe to say that if you put a working order in at 33, you weren't going to get filled. But it just shows how hot and heavily valued this company is.
They went up to $115 from 33.
Yeah.
That's incredible.
If I was Figma, I would be absolutely fuming with my banker. Yeah, for leaving so much money at the table. I'd be absolutely fuming. But yeah, so I think it's interesting to see. I'm happy that we're finally seeing a bit of a return to the IPO market. We saw Chime, we saw Circle, now we see Figma. So it shows great market sort of sentiment that we have a bullish, and they've all been successful IPOs as well.
Right, we've got a very good question there from Jesse14. When do the Dodge numbers start to show up in to the data? Well, government payrolls are expected to come in flat today because of that freeze, and the freeze has been continued on to October. So yeah, great question. You will see a soft number in the government hiring today. Of course, Sleepy Joe, that was what saved them.
Sleepy Joe, Creepy Joe, you pick your...
And yeah, Steve Davies as well. Good morning to you, sir. With our non-farm Friday. Cannot wait. But first of all, we're going to see what the chart of the day is. What country are we in? Oh, it's US.
United States.
US stock. Who's going to get this? You or I?
You know what? I'll give you this one.
Right.
You deserve it.
Before we go to break, we have to do our request for you. Yes, you at home, the one who isn't subscribed, go on, please give us a subscription, because the more subscribers we get, the more likely we are to get an FT subscription. So, help me, help you.
Please make sure Rich doesn't lose his pension. He really needs these 1,000 subscribers.
And also, if you like what you've seen this morning, if you like to see Ronnie reading out numbers off his screen, give us a like. Or if you prefer Piers in the seat in the morning rather than Ronnie, give us a like, and we'll take that as the vote of the day. Let's go to chart of the day. Hamish, are you ready? Let's go.
Opening bell.
Welcome back to the opening bell. Hamish, you are absolutely on fire. Did you used to work in banking? Because somebody clearly has spent a lot of time looking at charts.
Yeah, he was a bank teller.
A bank teller. Well done, Hamish. Quanta Service, of course, the beautiful thing that is my stock of the year. Didn't look like it in April. They had, in fact, no, it was DeepSeek. DeepSeek really knocked this off its perch. You can tell where back in February, and then yeah,
we're all
April
laughing
took it
at
lower.
you. And look at you now.
Look at it. Whoa, 250 to 400 in that straight line.
Why don't you pull up the SWC chart while you're at it as well?
Now, well, we'll go into that in a second. I'm almost honoured. So if you go to your watch lists on the platform now, on the left-hand side of the platform, they've given me what you could say enough rope to hang myself. So I now have my own watch list. Sosnov's got his, Bat's got his, and now we've got Rich McDonald's ones to watch. And oh, where have they gone?
Oh, great. That's how much they care for you, Rich. They didn't expect anyone to actually click it.
So we've got Marvell, of course. That is, I can't really take that one. That's Piers'. Novos, I have added that.
Are we buying the dip?
I have bought the dip. I bought the dip a little bit too early because it was a week yesterday. MicroStrategy, of course, that is a, you know, I couldn't put SmartWeb in there just yet. Maybe one day. And then Occidental, of course, because it is Buffett's baby. Anglos, I think, is going to get bid for at some point in the future. Diageo for the turnaround there with the new CEO selling off Guinness, maybe. GSK, solid company. Surprise, surprise, Vodafone. SSE, Uranium ETF, had to get that in there for Angeline. The Wisdom Tree, European Defence, that's the best way I feel to play the European Defence team. And ASML is in there. Let's go to the opening bell.
Brought to you by LSEG.
LSEG. Right, I can't get shorts in there. That's the problem. They can't differentiate what would be long and what would be short just yet.
Yeah.
So they could only put long. So that's like my long-term
You're long only.
ISA SIP long only.
Okay, I like that. Yeah,
Because there would be a few shorts in there.
You do need to start thinking about the pension, Rich. It's just around the corner, mate.
Right, Watches of Switzerland, where Ronnie gets his Casio from, down 5% this morning. GSK down 1.4. Ronnie, run us through some of those.
Yeah, Flutter Entertainment, gambling behemoth, down 2.42. GSK dropping down as well, 1.66. St. James Place had a brilliant day yesterday. They rallied after the increased inflows. Seems like people have not realized how to read about fees. But now they're coming back to it.
What they should be doing is watching a podcast about managing your own.
Exactly.
Money.
You can get better returns than cash and cheaper products here at IG, the leading investment platform.
Right, on the upside, Unilever carries on from its good numbers yesterday, up 1%. They're going for safety. British American Tobacco coming in for those defensives.
BAT is just beauty of a company. Continuing to beat, continuing to raise dividends. Now that's a company for the ISA.
Yeah, well, that was £28 at the. It didn't look good at all. The CEO wasn't really producing the goods. They didn't believe him, but stock up 40% from the lows.
There you go.
Glencore bouncing from yesterday's weakness, and yeah, otherwise,
What else
we have had numbers from IAG. I don't see them anywhere yet. Shall we have a quick look at IAG? That's British Airways, by the way.
Oh, thank you for clarifying.
Right, up 2%.
Yeah, well, there are I think they're making progress on the third tarmac. What's it called? Third terminal.
It's a terminal.
Runway.
Tarmac. There you go. How about read that? You read that out, Ronnie.
Okay, I'll read that out.
Go to paragraph 4, the numbers in it.
Okay, I can read. IAG reported operating profit of 1.68 billion euros or 1.92 billion dollars for American viewers for the quarter, compared with analyst average forecast of 1.4 billion euros in an LSEG poll who sponsor us, and up 35% from a profit of 1.2 billion euros in the same period last year.
Right, stock up 2%, confident in the longer term outlook. So let's look at how that one is on the longer term chart.
You know, an interesting pair trade would be long IAG and then short Wizz Air.
Well, it's funny because our boss, we were talking about this yesterday, and he is, pretty bearish on Wizz Air's model. However, they've got a great order book with Airbus. So he thinks there's a chance that one of the private airlines might come and buy Wizz just for its order book. The business is terrible.
The business is terrible.
But it's hard to get your hands on planes in the next couple of years.
Sort of like buying a bank for the license.
Yeah.
Interesting take. So who do you think that buyer would be?
One of the Emiratis.
I mean, they did just shut down their operations in the Gulf. They tried to expand there, but they just couldn't make it.
Not enough planes.
Not enough planes.
Right, so British Airways, that's a beautiful chart, isn't it? Well done, British Airways.
Yeah, we've been bullish on British Airways for quite some time. Yeah. One of the few stocks that we actually agree upon.
Took me safely to Ibiza and back last week. Very happy.
I thought you were more of an EasyJet, Jet2 holiday guy.
I would have, but it was the lads that booked it. So, right, AstraZeneca now down 3 and GSK down 2. Great start to the watch list. Barclays.
Oh, did he say long only? He meant short only.
Yeah, exactly. Yeah. Sorry, they're all shorts. Right, let's have a look. Oh, Adidas, that would have been the dream short. We did try to talk about it and then didn't put a position on, did we?
Yappa.
So Schneider down 2%, Adidas down again for the third day running from 210 to 165. The party is over.
Yeah, I mean, it's over, and the question is, when will it come back?
They've got to invent a new shoe that doesn't look like it's from 1970.
But isn't that the fashion trends,
No, but well, it has been, and that's the problem. It's done. Yeah. Everyone's got them.
Move along with the times.
Yeah.
Yeah. It's interesting to see the European banks, because they've BNP Paribas and Deutsche up there, because the European banks have had brilliant results. Deutsche Bank in particular, they had excellent results. I think they increased the revenue by like almost close to doubling it, because they had such horrible results earlier.
Wow.
So I guess that's a bit of a pullback, and I wouldn't read into that much. It's more of a take profit more than anything. Deutsche Lufthansa. Oh, thank you. Yes. Deutsche Lufthansa and Ryanair both down as well. Airbus as well. The airline industry is taking a bit of a toll. Not everyone can be as brilliant as the great British Airways. Salute.
So we see what's going higher in Europe. Are there any? Go.
Bayer for once. Oh, is that Bayer showing positive? Herring as well. And Puma. What's going on? It's the reverse day today.
It is, isn't it? It's all the top shorts.
Yeah, the top shorts.
Yeah, people have seen that they're having to take their gross down. Of course. Excuse me, if you're taking your gross down, what do I actually mean? That screen off, thanks guys. So if you are running, let's say $100 million in a hedge fund, then you've got 50 million of longs, 50 million of shorts. Of course, you've got the best stocks in the world against what you think are the worst stocks. As your longs go up, you've made a lot of money there. As your shorts go down, you've made money there. But when things reverse, you've got to sell the good stocks, which is exactly what happened yesterday, which means if you've taken your gross down to 70 million book, you got to buy back 15 million of the shorts. Now, of course, the shorts, everyone's in them, right? All these guys at Millennium, all the ones at Citadel, everywhere, are all buying the same stocks to buy them back. And that's why you get these strange moves of the unloved stocks going up while all your top ones are dropping.
You know what? That was actually insightful, Rich.
And then if you see 2 or 3 days of that, that's when you start to see real pain, real losses. And when the losses happen, vol starts to tick up. So let's see what volatility has done. Oh, surprise, surprise, it's up 2%. Let's look at that. Yeah, there we go. From yesterday at, to 2:30. There we go. Vol is up from 18.3 to 19.3. Doesn't sound much, but that's a 5% move.
Yeah, I mean, just the volatility index has itself been extremely volatile in this past year since April. It's just going all over the place. We were actually talking about this on the desk and sort of getting some sort of exposure to this, and perhaps looking at ETFs that one could invest in. Do you have any suggestions, or should I?
For vol,
Yeah.
They have to be such short-term plays because they're usually they have to sell the front month and buy the back month, which means you're selling at 17 and buying at 19. So it's destroying value the whole time. So if you hold it for longer than 5 days, then it's very hard to make money.
Yeah, but it's for a short-term hedge play. It's something that could work brilliantly in a market like this. What else do we have going on?
Did you find the ETF?
Yeah, so
I think this is it. The ProShares VIX short-term futures
exactly
ETF. And I cannot stress enough, this is a short-term vehicle. But when it has, when it's dropped so much, then, if you thought that vol was suddenly going to be up at 22, then this is one way to
Hey,
play
if you like them up there, you'll love them down here.
Right, what else have we missed? We've missed commodities and FX, that big drop in copper just 24 hours ago, 36 hours ago, I guess now. Let's update you on the commodity market. Go on, Ron Dog.
All right, we got oil remaining steady at oil US crude remaining steady at 68, down 15 basis points, nothing too crazy. Oil Brent crude remaining at 71.5 roughly. Spot gold remaining high 3,000, 3,290. We've seen some peaks at that level. I'm wondering if this sort of market volatility and sort of shaking in the market can push gold up, and it looks like it's going that direction today. Spot platinum.
Yeah, that's come off quite a bit, hasn't it?
It has indeed.
Oh yeah, wow.
Oh, blimey. What's the cause for that, Rich? You're the commodities guy.
More sellers than buyers.
That's an excellent analysis. I never thought about it that way. Thank you very much for that extremely insightful comment.
But yeah, I think anything that's, momentum has clearly now shifted.
Yeah.
It might come back, non-farm payrolls, everything could change, but there is the winners, the momentum has now changed. Now, talking about non-farm payrolls, let's get a quick poll in for your non-farm payroll guess. It's up there, and that's the result, is it? I didn't even get a chance to vote. Oh. I actually don't know what to think about today.
Well, if you don't know what you think about that, I do have a question about something you might have an interesting opinion on.
Well, take us through the non-farm poll results first.
Yes, non-farm payroll guesses, question mark. More than 110K, 34% agrees with that. 110K, which is in line with the forecast, is 27%. Less than 110K is 25%. And less than 100K is 13%. And that's 44 people voting. I would say my guess is in the top more than 110K. I think we're going to have some pretty strong results coming out.
Yeah, that is. He's gone a little bit low there, considering the whisper number is 120.
Yeah. Apologies for producer Phil. He was busy playing with the China button.
He couldn't find Only Time Will Tell.
That's my favorite.
So yeah, the chances are, yes, it's certainly, with everything going into it, you would think that they managed to eke out a 123. So that's mine. 1, 2, 3.
1, 2, 3.
The opposite dusty bin. A reverse dusty bin. You don't know what that is, do you?
Speaking Chinese to me, mate.
2.
Yeah, so we were on the commodities. Speaking of, we've got ExxonMobil and Chevron. I know you're a big Occidental guy, but ExxonMobil and Chevron are both reporting today. What do you think we can expect from those? Because we've had quite low oil prices and quite volatile market as well with the geopolitical environment.
Yeah, it's not been the ideal situation for these producers, has it?
No, I mean, oil has been sort of the safe play leading up to sort of beginning of this year.
Yeah.
It was sort of a safe bet, especially with Trump coming in. It just rallied, especially all these oil companies. I think we're seeing sort of a back to normalization now. OPEC isn't doing things much better as well. So I think we're going to see some quite disappointing results there.
Right, one to take you through that has jumped out. BT cut to neutral at Redburn, so that was expected to weigh on BT there. And then Pearson had their interim results, adjusted operating profit 242 million, which was pretty good. Pearson trying to shift everything online. So people, how have you been getting on this week? It's been a week of ups and downs, certainly. Boston Frank pointing crypto is down because there's more sellers than buyers. Let's look at those.
Should get him on the show.
Crypto, well, I think the clue's in the name. He'd have to dial in. Now, to be frank, how is our crypto looking this morning? Well, it's 114,000 or 115. It's just dipped under there. And then Ethereum 3645.
And for those of you who aren't professional traders and can't trade Bitcoin or crypto on leverage, IG is now the first major UK broker who offer cash cryptos to their clients.
And great.
Trade at your own risk, of course, obviously. It's a highly risky and volatile asset.
Now, talking about crypto, we've got a podcast for you coming out this evening. So we did our fourth podcast yesterday, and it was the last of the asset deep dives. So myself, Poppy, on the chat, and Spice I must admit, we meant to record for about 45 minutes, and we recorded for 65 minutes because there was so much to say. So if you're interested in how the commodity landscape looks and if that could be or should be in your portfolio, how to put it into your portfolio, then we've got a great podcast coming out where you get your normal podcast. That could be Apple, it could be Spotify, it could be Audible, or you can get it on the IG.com YouTube. And yeah, we go through all the commodities. We go through gold and we go through crypto as well. Plus a good story from Spice on when oil went sub-zero.
Oh, the good old days, eh?
He was trading it and he was short.
Ooh, interesting.
Little teaser there. Spice had to phone up and ask, what happens if oil goes negative?
Did you get any tankers being delivered up to Perth?
Do you know what I almost... So the timing of when it went to negative 40, right? Obviously, none of the cruise liners were... You didn't know if they go out of business.
Yeah.
So we actually looked into leasing a cruise liner and seeing how many barrels we could get delivered for negative $30. So we'd receive $30. Would that be enough to lease the cruise liner? Because they're sitting empty. So
what happened?
They weren't too happy about all the dirt and the idea of pictures being taken for their brand with 200,000 barrels of oil sitting on there.
Not very ESG friendly.
Two-tier Kia, well, that's crypto is not a commodity, so is gold a commodity? Because if gold's a commodity and Bitcoin is mined, then to me...
And it is the digital gold, my friend.
Yeah, so don't know about that two-tier Kia. It's not a definite answer one way or the other. I will completely agree with that. Right, I hear Martin Harris in our ear. So we're going to have a quick wrap with a final look at how these UK names are looking. The worst performer on the day, St James's Place, giving up some of yesterday. AstraZeneca down 2.7, GSK down 1.6, and Scottish Mortgage Trust following the Nasdaq lower, down 1.5%.
We do love the Scottish Mortgage Investment Trust. Big bulls.
Luke Moore, it's Luke Moore's big one, isn't it?
Yeah, he converted me.
Right, a very quick question. What are you doing at the weekend, lover boy?
I actually have my best friend from Sweden coming to visit, so I'll be with him, but I will be perhaps combining the two worlds of my newfound...
Your best friend's going to meet the girlfriend?
Hopefully, yes.
Oh, the smile on your face makes my heart smile.
Thank you, Rich.
Right, I'm going to have a quick coffee and go and meet Joe. Joe will be with us for some macro chat in 20 minutes. But first, it is the mighty Martin Harris taking over. See you in 2.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey,
Oh, thank you for showing me where it is. I have no idea where the economic calendar was made.
Oi! Oh, you're not going to get better than cash returns.
Yeah, bloody tosser. And graphic in there. Mate, what the fuck are you wearing?
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Bring me the next shiny new thing. Bring me the next shiny new thing.
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs, from scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
Hello and welcome back to the Ronnie and Martin show, where the two friends from across the different teams at IG combine knowledge, experience, and we bring you what's up on the week ahead. Martin, very welcome. How are you this brilliant Friday morning?
I'm doing great, Ronnie. I think this is fascinating because I don't have the live video feed coming from the studio, so I'm watching myself back on YouTube with a 2 or 3 second delay.
Things that nightmares are made of. Hopefully we can give the viewers at home a better experience than you're experiencing, my friend. So as the name of this show is, the focus of this show is to talk about the week ahead. And we figured, you know, producer Phil and I, we were sitting there brainstorming and we said, who's better than Martin Harris, Mr. Macro himself, under the macroscope Martin Harris, to discuss what's coming up on the week ahead. So I've pulled up the economic calendar here on the IG website.
Thank you.
And I'm going to filter for high importance. That's the most important things that's coming up in the week ahead. We will move on to earnings. But before we do so, we want to do a little bit of a macro dive. Martin, can you tell me looking at what's coming up this coming week, could you tell me what's popping out at you and what do you think will drive the markets most?
So look, the real, obviously today, and you and Rich have spoken about it ad nauseum, so we're not going to go into it, but it's the NFP, that's the real one to watch. It's going to be much more important than when we look at the PMIs coming out on, is that going to be next week, Tuesday? Other than that, Chinese imports year on year and exports, fascinating to watch. Really going to be important for us to see how Chinese stimulus is affecting their local markets. We're quite bullish on China at the moment, really given the stimulus. And I think that the concerns for an economy like China is that they almost constantly require government stimulus to get things going. Really somewhat cautious. So you want to see if that's working. And then we get again, Bank of England interest rate decision, not holding out for anything too exciting there.
Yeah, when the stimulus came out from China, I mean, they were in quite a dire spot, especially with the real estate crisis, and their approach was sort of to give the local governments funds to stimulate the economy, and they've also had countrywide stimuluses going on as well, but it wasn't really taken quite positively by the market. You said you were quite bullish on China. Would you say that the market's initial reaction was incorrect and it has been working? And do you think they will see results that will sort of confirm this? Or what are you expecting?
So I think, look, the real estate sector in China, I think, is still in a difficult position. It's been well supported now, so it appears that the initial and immediate fears around a total collapse of the real estate sector, any kind of, just no one was buying any new builds. People weren't, the existing market was collapsing, so there wasn't worth buying anything else. And very almost like a UK property market on steroids, a lot of wealth tied up in property in China. And so when the Chinese property market is weak, the consumer is weak, the consumer doesn't want to spend, they put a lot of their savings into property. So the Chinese government needed to first of all support that. The part of the Chinese market that we like is media, Chinese luxury goods, and Chinese online gaming. So the ETF that sort of wraps all of that up is the Crane Shares K-Web ETF. We really like Chinese media, and Chinese online consumer goods. So the likes of Tencent being kind of the primary sort of stock that we want to get exposure to.
Apologies, Martin. What did you say the name of the Crane Shares ETF was?
K-Web.
K-Web.
K-W-E-B. Yeah, so it'll be China Internet.
Here we go.
Just put in K-Web. Yeah, don't worry about putting the full name in. Just put K-W-E-B.
Okay, we got China Internet up here. We'll settle for that.
There we go. We'll settle for that.
Yeah. And do you have any companies in particular that you're looking out for? Is it the big ones such as Tencent, that's the usual suspect, or do you have any other companies that are drawing your attention?
Yeah, Tencent, Meituan, those are the two that we really like, and then always following what's happening to BYD in the EV space, heavily subsidized by Chinese governments and making sort of severe inroads globally, really at the forefront of pushing Tesla on battery development. So always interested to see what BYD are doing, and I think the only way that BYD is stopped is with tariffs, so on Chinese vehicle imports.
Yeah, and BYD's obviously, like you say, they're making strong inroads into the European market. I've personally started noticing a lot more of them, but there are also other actors in the Chinese. There's sort of popping up new Chinese EV actors every 2 seconds. It feels like we got Xiaomi, who's gone from making electric scooters and speakers to now making EVs, who are selling, like hot butter. I don't know if you can say that, but you get the point. They're doing very well.
Hot cakes, I think, is
like hot cakes. Yeah, like hot cakes. That's what I meant. Thank you. You see, we complete each other, my friend. Very interesting there. And also, one thing that I was looking at before we dive into what we expect the BOE and Andrew Bailey to do. Germany. I mean, Germany has been Europe's biggest economy, but it's also been almost sort of Europe's biggest lagger. Now we have the stimulus of the $500 billion trade, but with all the red tape in Germany and the sort of struggles of the major industries because of players such as BYD, what are you expecting to come out from the balance of trade? Do you think that we're going to see some negative results, or do you think that we're actually going to see some trickling down of this massive stimulus package that they have?
I don't think that we're going to see that stimulus package trickling down just yet. Major concerns are going to be the tariffs on European goods coming up. We're not going to see that affecting anything either yet. So what we would have actually found is that a lot of European and German, in this case, exports ahead of the tariff deal that went live. It goes live in now it'll be 6 days time. So there is a pause for, I think, any goods that are on the water. They've got 7 days until the new European tariffs are enacted. So, and alongside that, if we look at what's happening in the United States in terms of these inventory builds of goods ahead of Christmas, we actually don't expect the tariffs to actually have any effect on inflation until, we might start seeing it in December, January.
Very interesting. And quick take before we move on to equities. Could you tell me, BOE interest rate decision, cut, hold, what are we expecting?
Hold.
Hold.
Expectation is a hold. We'll have to see. I think BOE conservative at this stage. As soon as there's cuts abroad, we might see something change.
I've got producer Phil shouting in my ear, but before he kicks us out, there's 2 stocks I want to get your hot takes on. They're reporting next week. On Monday, we got Palantir. On Tuesday, we got Advanced Micro Devices. Do you have any sort of expectations on these 2? Because we had the big tech this week, and what do you expect from these 2?
So, very quick. How much time do we have?
Take your time. Don't let producer Phil stress you.
Before we get into that, what I want to do is a bit of a read across from what the earnings that we've seen into where we're going. So, Microsoft, stellar results, really setting the stage for AI and software at the moment. But it's really what we're seeing now. The companies that are monetizing AI are being rewarded rather than the companies that are just throwing cash at building out AI. This kind of comes across that so the kind of stocks that we like, particularly on AI software, semiconductors, and infrastructure builders who are making money out of the AI spend. Just quickly into Microsoft, a lot of strength in commercial bookings and Azure acceleration. So I'll touch on Azure again later with Amazon, but Azure alone, the market expected 35% growth. Microsoft delivered 39%. So this is very positive for other database companies associated with Microsoft, specifically Snowflake, MongoDB, really positive for them. CoreWeave is another infrastructure supplier, really positive for them. And I think this almost ties into like the number one question we get at the moment is why are the semiconductors down? Why would Nvidia be down, AMD, and so on? Previously, there was a lot of investor overhang around what their question around weaker demand. Right now, that overhang has disappeared. 3 months ago, there was a concern around demand. The overhang has disappeared. The Chinese market is back open for the likes of NVIDIA. Sovereign AI spending power is the game at the moment. So for most governments, the security dynamic is now moving into AI, and so there's a lot of spend coming through there. The adoption for AI is huge. The TAM is essentially the entire world. And so those what we're expecting going into next week is that there'll be a flow through for those stocks in those sectors to be positive. Very quickly onto Amazon, which was, despite, they reported late yesterday, and had a beat on, their second Q2 result, also better than expected guidance for Q3. But you got a negative price reaction after the print, and that's likely because of the weaker Amazon Web Service year-on-year growth compared to the likes of Azure. So also a bit of a factor of the arrival of higher Amazon Web Services costs. So that's what we're looking at. That kind of sets the scene. Today and going into next week, Palantir being the big one. I had some notes up. Effectively, I think just with the sake of time, let's go through this quite quickly. Palantir, massive growth. The main concerns there is that really driven hard by government contracts. If those government contracts have now basically all been signed, the order book is full, we need to see some changes or some growth coming from the consumer side. So that's Palantir. Which other ones did we want to touch on?
I don't think we have time, unfortunately. We'll have to save that for our imagination offline. But thank you very much for your time, Martin. Insightful and entertaining as always. Infotainment, one would call it. Thank you very much. And
thank you, Ronnie. You're always the best.
Thank you.
In the last video, we talked about how the S&P 500 has a higher PE ratio than the FTSE 100 because investors expect faster earnings growth. But let's look at what happens when those earnings actually grow and why that makes such a big difference. Here's the S&P 500 in year one. Its PE ratio is 24 times, which means investors are paying 24 times the earnings to buy shares. This tower represents the share price. The height of each block reflects the unit of earnings needed to support that valuation. Now, let's jump forward to year two. The share price hasn't changed. This tower is exactly the same height, but look what's happened to the earnings. Each of these larger blocks represents higher earnings compared with the smaller ones from year one. Because the earnings have grown 50%, what used to be 24 times earnings in year one is now only 16 times earnings in year two. That's a huge improvement in valuation, even though the share prices have stayed the same. This is the power of earnings growth. When companies deliver stronger earnings, the PE ratio naturally comes down, making the stock look cheaper, even if the share price hasn't changed. And when investors see that kind of growth, they're more likely to stay invested or even buy more shares. And that's what pushes the PE ratio back up. And that's what makes shares go up or down. Now compare that to the FTSE 100 where earnings grow more slowly. Even if the share price stays the same, the PE ratio doesn't improve as dramatically because the earnings aren't growing as fast. That's why growth is such a critical factor in investing. It's what drives long-term value. So here's the big lesson. Earnings growth doesn't just boost a company's value. It makes the stock more attractive by improving its valuation over time. As an investor, the holy grail is to find companies that can grow their earnings by more and for longer than other investors may already expect. This may even mean avoiding shares that are already very popular, overowned, and potentially overvalued. Because if a stock on a very high PE ratio misses its earnings estimates, then the price can come crashing down. Welcome to our Expert Edge section. I'm very happy to have Panmure Liberum's Head of Strategy, Joe Clement, back with us.
Hi, morning.
As Angelina's off sunning herself.
Yeah, and she's right to do that today because, you know, it's a boring day in the market. Nothing happened this week, so it's all fine. It's the best time to go on vacation.
That's we actually said, you know, it's a quiet week. There's no news.
No.
Yeah.
No, I mean, seriously, I was like, on Monday I came to the office and I was like, what am I going to do all week? And next Monday I'm going to come to the office and it's like, yeah, still nothing to do here.
What has been the most important thing so far this week, or is it still to happen, do you think?
I think it is happening right now, obviously, with the market digesting the tariff news.
Let's get the chart up there. Sorry, Joe.
And especially, I would say, while most of us here in Europe don't have really a big surprise, I think the massive surprise is Switzerland. 39% tariffs on Swiss imports on Swiss exports to the US. Now, that obviously excludes pharmaceutical exports. They are going to be separate, and 60% of Swiss exports to the US are drugs and pharmaceuticals.
Is that from Roche?
Roche, Novartis, Lonza, the big three, but also like small biotech companies, etc. But even so, you know, the Swiss exports to the US, if you exclude pharmaceuticals, which I think will sooner or later be hit with a 25% tariff, which will be really bad for Ireland as well, because that's the other big country in Europe that exports pharmaceuticals to the US. But if we take that to one side for the time being, guess what? Your Swiss watches in the US are suddenly becoming much more expensive. And I think companies like Richemont and Swatch are really going to be hit today.
Let's have a look at Richemont, because we can look at the South African price over there, and you are spot on. Down 3%, Richemont, which is almost back to those April levels. Of course, the maker of some beautiful names, Cartier, the Mont Blanc pens, for example. Lots and lots of watches. Richemont is really dominant in the watch space. Longines, Cartier, those kinds of watches. Yeah.
If you go to the top end of the watch space, Rolex obviously is private, so we don't know, but they're all manufactured in Switzerland, so your Rolex in the US is certainly going to jump.
I've just remembered it's a Swiss national holiday. That's why they aren't open. I was looking for the Novartis price.
Oh yeah, of course. It's Swiss National Day, 1st of August. And I was checking the Swiss newspapers this morning, and they are, well, their gasted is flubbered, to say, to put it like this. They did not understand why they were caught with a 39% tariff, especially because that is even higher than the 2nd of April Liberation Day announcement to begin with. And my personal, as somebody who has lived in Switzerland for 21 years, as a German, my personal interpretation is simply the Swiss try to do what they always do. They're very deliberate, very unflashy, and they try to negotiate in a Swiss way, like they always do. And then you're kind of meeting your nemesis in the phrase of Donald Trump, who wants a flashy outcome and he wants the results quick. And Switzerland and Swiss people just aren't built for that. And I guess in the end they thought, well, we just kind of piggyback on whatever the EU gets, and then that's the same thing. And I think there's a rude awakening today in Switzerland with that.
Now, let's move on to that EU deal.
Yeah.
15% rushed through, perhaps.
Yeah.
Will there be a political fallout? And do they have to vote on whether they accept it?
No, they don't have to vote on that. So that's totally within the power of the European Commission to negotiate these and to accept these. But what really annoyed me terribly when I came back into the office on Monday, because on Sunday I wrote my reaction piece for our clients about the EU deal. And I thought, well, that's pretty mainstream. It's pretty much the same thing as Japan. So it's not great, but in the end, it's actually a good deal for Europe because effectively with 15%, they get the same tariff as their competitors from Japan and a lower tariff than Chinese competitors. So in the US, they might even gain market share from Chinese firms.
Right.
I come in and the entire press is like, this is the worst deal ever. This is a capitulation, etc. So let me make my point. Okay, I've already made my point. 15% is the same as Japan. And a week earlier, Japan got 15% and promised $550 billion in investments in the US. And it was celebrated. The Japanese market was up 3.5%.
Yeah.
Now, the EU gets 15% and promises 600 billion, which as a share of GDP is much, much less than Japan's costs. And people are like, this is a capitulation, this is an absolute disaster. Let's face it, $600 billion in investments from the EU into the US is effectively what European companies have invested since 2022 over the last 3 years anyway.
Okay.
So that's an empty promise. It's just a wonderful headline that doesn't mean anything. And the other thing was $750 billion in energy imports, at which point you have to say, over the next 3 years, the US can't even deliver that many oil and gas and coal exports to the EU.
They
so
can
that's
from Russia via the US. They can do it that way.
It's just impossible because the US, and where it really, the bottleneck is not the production capacity of US oil and gas producers and coal mines. It's the harbors. LNG ports in the US are already operating at capacity. They can't expand their capacity anymore. So this is all just literally bullshit. The 750 billion is a complete nonsense number, and the 600 billion will happen anyway.
What about the reaction of euro-dollar? So let's have a look at that chart, and you can see that it's come off from 117.5 to 114.
Yeah.
Those are big moves.
Yeah, no, absolutely. The dollar is the Lazarus, so to say, coming back from the dead. And to be perfectly honest, the dollar was, from a sentiment perspective, very oversold. I personally like the Centix, the weekly Centix survey, where people have been euro bullish more than any time in the last, I think, 20 years or so.
Yeah.
So I think this is not necessarily a massive trend change, even though I know we've broken through trend lines that are quite meaningful. I think over the next 1 to 3 years, the dollar will still continue to weaken because the fundamentals of this entire trade deal are horrible for the US.
For the US?
For the US.
Across the board, not just the European.
Across the board. So to give you a couple of numbers, and we have our own forecast. So we think that the deal as it is right now will add 1.1% of inflation over the next 12 months. So pushing
on
US
top of 2.5.
on top of 2.5. So basically pushing it in the 3.5 to 4% inflation rate in early 2026. We also expect that US GDP will get roughly 0.7% hit from those tariffs over the next 12 months. In the long run, we expect the US to be 0.4% smaller in terms of GDP economic size than it would have been without it. While the EU is actually going to be a little bit bigger.
Right.
Yeah, because as I said, they pay a lower tariff than China. So a lot of American importers, if they can't get it at home, will import it from Europe rather than China.
So together, as a US against rest of world, you still believe in this deterioration of American exceptionalism?
Absolutely.
Okay.
It's just a matter of time.
Because
I mean, and by the way, I am actually one of the least pessimistic out there. I did a little bit of an exercise. I don't really have the details of other forecasters, but I have the details of 2 other forecasters, which is the Yale Budget Lab, which makes its forecasts available for free. And they expect that inflation will go up by 1.4% and the US economy will shrink by 1% to 1.1%. Bloomberg Economics, the other ones that I have access to, expect inflation to go up by 1.8%. I have no idea what kind of a model you have to have in order to come up with 2%, but more than 1% drop in US GDP. In other words, the US is hitting a really big stagflationary hit now, which also means that the Fed can't really cut interest rates.
How do we put that into trades then? Because, you know, we know what we think of economists, we know what we think of their data and their models.
Go on then.
Your job is to take those models, take the theory and put it into a strategy on how to make money.
Okay, 2 trades. Number 1, I continue to be short treasuries. I am in this camp where I think the 10-year treasury yield will move towards 5% in the second half of this year. I'm still hopeful that it will cross the 5, but it might just fall short of it a little bit. But that's still, we're still talking 50 to 60 basis points higher yields from where we are today.
Okay.
And then the other one is...
Sorry, I just let's get those up. So you're talking about the 10-year going from 4.38 to above 5.
Yes. So as I said, it might fall a little bit short, but 50 to 60 basis points higher from where we are here. You want to short the 10-year at this juncture.
Shorting the bond.
Shorting the bond, higher the yields. And the other thing that I would do at this point in time is if I have a long dollar position, I would take strength in the dollar to take some money off there and put it into mostly, I would say, euro. I would have normally said Swiss franc in euros, but after today's Swiss news, I wouldn't put it into Swiss franc anymore. That is a good currency to be in. I also do think that British sterling could be an alternative, but I think the first candidate to put it in is the euro.
It's funny because Poppy and I, on the chat, who is, of course, Mr. CJ Fellingham of ex-Soros, ex-BlackRock, you know, a long list such as yourself. So 2 very wise gentlemen that have been in this market for long enough to know and to call things, also thinks that GBP has a rally off the now sub 132. Bank of England next week, one of our viewers said 100% nailed on cut. What was your answer to that in one word?
I think that's bullshit. I mean, I think it's literally a 50-50 shot. And the reason is that inflation pressures in the UK are building as well. And what the PMI data shows, and yes, I say this on a day when an alternative business confidence index struck a new low. So business confidence is not that great, but in the manufacturing sector, we actually do see that. And what crucially we do see in the manufacturing sector is price pressure. Manufacturing companies report higher cost pressures, higher costs that are coming through. And if the Bank of England pays any attention to that, it is not that clear cut. Now, having said that, if they cut next week, then I think they will cut maybe one more time in December, but that's about it.
Okay.
And if they don't cut next week, then they will cut in September at the next meeting. So overall, I think it's a matter of timing and when, not if, because I think that the Bank of England will cut one more time, possibly 2 more times. But given our leading indicators and our confidence that the UK economy is actually strengthening a little bit, I think it's more 1 time than 2 times.
Would you rather be in Andrew Bailey's shoes or Jerome Powell's?
Oh, easy, Jerome Powell's. Much easier. first of all, I would have to do the job for less than 12 months. And second of all, the picture in terms of inflation and growth is so easy for the US. It's a stagflationary impulse. We already see in the most imported goods a massive increase in inflation in the US. And from a political perspective, if you want to defend the independence of the Fed, then you steadfastly push for no rate cuts in the second half of this year, which would be good to fight inflation. It would be good for the independence of the Fed. It would be roundabout the best thing to do.
Okay, so your idea of higher yields comes from inflation. It also comes from a stubborn Fed, rightly so.
Yeah.
What about deflationary impact of things like AI?
That is a long-term story. First, we have to basically deploy all those investments. And here, I'm totally a fan of AI. I think it is really a game changer in some industries. It can increase productivity. But I'm also concerned that people get carried away a little bit, as they always do. That's a normal thing. But to be perfectly honest, if you look at, not Aswath Damodaran, who won the Nobel Prize in Economics last year? The MIT economist. But he says, he calculates that over the next 10 years on the US economy, the productivity gains from AI will be 1% cumulative. So 0.1% per year. And the argument he makes is that, yes, there are certain roles like being a law clerk or being a software programmer where your productivity gains are huge, but you lose some of those productivity gains because you have to check AI all the time.
Right.
You spend a lot of time checking the output that your AI gives. But if you don't, you submit legal cases to a judge and the judge finds out you're quoting made-up cases and the entire case gets thrown out.
But this happens.
This happened.
Yeah.
It's not happens. This happened a couple of times in the US now.
Yeah.
So you basically risk losing the case because you didn't check the AI output. So you lose a lot of your productivity gains in just checking it. And then the other thing is that, a large part of the economy is not threatened by AI. If you are a cook, well, what is generative AI going to do for you except pull out maybe a nice recipe, but afterwards you still have to cook it yourself.
Yeah. Okay, so you'd be happy to be in Jerome Powell's shoes because you would be happy standing up to Donald, who we've just heard the new acronym of DEAL, which is Donald expects a lot.
Yeah, he does. Whether he gets it is a different story.
Yeah, the art of the deal. But what about the effect on earnings and therefore the S&P 500? Because we are seeing these behemoths come through with the huge numbers and the huge capex, which feeds into benefits for other companies. Are we at a stage now where you can't, the S&P 500, there's no point in looking at it because it's only 10 companies?
So yes, so that's indeed what we also see in this earnings season very clearly. So services companies, whether it's banks or software services like Meta, like Alphabet, etc., they are doing great. Why? Because, well, they are not directly impacted by any tariffs and they're benefiting from the AI investment boom. So that's really good for them. And that is something that carries the S&P 500. The moment you go into the manufacturing space or the retail space, consumer products, you even saw it with Apple's results yesterday. They had fantastic results because iPhone 16 sold like hotcakes, but Tim Cook was honest enough to say that a lot of it apparently was people rushing to buy an iPhone 16 before the tariffs come into place and they have to pay more for it. So expect the Q3 earnings to be somewhat muted and Q4 earnings as well.
And a lower margin because of tariffs.
And the lower market because of tariffs. And then if you look at GM and other companies that rely heavily on imports, they're all taking massive hits from the tariffs. So Stellantis, as taken 2 billion down and GM 1 billion, or the other way around. It's like one was 1 billion, the other one was 2 billion. But it's ridiculous amounts of money that they are basically being hit with at this point in time. So I would say the S&P 500 is going to be even more a tale of two markets, with tech services going okay. And probably the only thing you have to worry in tech services is if you really believe my story about higher treasury yields, that means higher discount rates, and that's usually not great for growth companies. And then the rest of the index, especially manufacturing and consumer goods, really in dire straits in the second half of this year.
So it's tricky to put on value versus growth because you do have a lot of those.
You can't do any of that, really. The best thing you can do is actually at the moment put a quality, so high profitability, because that will naturally zoom you into some of the Magnificent Seven that is not Tesla. Good.
Yeah. Well, that takes us perfectly on to the European autos. You mentioned Stellantis there. Renault had horrible numbers.
And they don't even export to the US.
There was no excuse.
There's no excuse.
The Chinese are coming for us.
Yes.
Now, Piers and I actually took a BYD vehicle into work yesterday.
How was it?
Do you know, it was very comfortable. It looked good. It did the job. The driver said that it was just a basic model, so the miles per gallon weren't quite miles per gallon on an electric vehicle.
I was just going to say the range.
the range
and the
consumption pretty standard. But I'd rather have that than a Renault. So where do we sit with these European autos? Because
I'm still short European autos.
Okay.
And for two reasons. The US isn't really that much of a big deal unless we're talking about Aston Martin or Porsche. But mostly it is about the lack of demand from China. So whether we're talking Volkswagen, Mercedes, etc., they're all struggling in China, which has become their largest or second largest market. And then the competition in the EV market. All over Europe, the European manufacturers are still years behind Tesla and the Chinese.
And billions of capex.
And my favorite statistic is if you look at new electric vehicle car sales in 3 years ago, 2021 or 2020, Chinese EV manufacturers were less than 3% of new electric cars. At the end of 2024, we're talking about 24%. So they basically are, at the moment, cleaning up the entire market. Because one thing we learn is that while there's a lot of brand loyalty, and I say that as somebody whose dad worked for Mercedes-Benz his entire life, everybody in Europe, especially in Germany, we have a lot of brand loyalty. Once a Mercedes guy, always a Mercedes guy. You don't switch to BMW because you will be disinherited by your dad, I can tell you that. But to change to an EV, people are willing to try something new.
Yes, very true.
That's such a big structural change. And then if they sit in a BYD or an MG or a Tesla, and they find out, well, it's actually just as good a build quality as a German-made car or a French car.
I can't believe what I'm hearing. Please don't put German car and French car in the same sentence.
Yeah, okay. All right. That might be a bit much, but German car.
Right. Let's have a really quick look at how these US all sessions are opening in the all sessions opening bell. Oh, Amazon is leading us lower. Amazon down 7%, Joe. 7%. Tesla following it down as well, 1%. We got Intel, Nike, Boeing, all on that losers list. AMD down 3%. Down she goes.
And Amazon is a bit of a surprise that it reacts that much. I mean, the numbers weren't great, and yes, one of the key problems for Amazon's are the tariffs, and in particular that the Trump administration said that it will skip the de minimis rule. So anything imported into the US that is valued less than $800, which at the moment is not tariffed, will be tariffed in the future. And guess what? That's horrible news for Shein, which isn't listed yet, or are they listed?
Not yet.
Okay.
Not yet.
Well, they're hit by one bad news after another, but it's definitely also bad news for Amazon.
Most definitely. Apple holding its head above water, though. Of course, it was the one that is under-owned, underappreciated, and has underperformed. So that one's up 2. Microsoft holding the 536 level, down from 560 at one point yesterday. But some of the other movers, oh boy, Coinbase. I have never seen such a bad interview as the Coinbase CFO on CNBC yesterday. She was terrible. Reading off a laptop like this. Yes, we think for the next quarter that, there might be some costs involved. It was embarrassing.
Oh my God.
And hence, down 11% on an earnings miss of a stock that has really done very, very well. And then, taking some of the others down with it. But you said you're still short European autos. What's the long against it?
So at this point in time, the longs, I am still long European banks. And I have to say BBVA has jumped 6% the last couple of days after they presented great earnings. UBS has done extremely well as well. So I'm inclined to take profits there. The ones where I am still very long is airlines. In particular,
Wish you the best for the weather tonight, because you could be off to a comedy night, hopefully.
well, if it's not raining, I'm going to the Ealing Comedy Festival in West London, but it is outdoors, and if it's raining and muddy, I'm not going because I'm too old for Glastonbury, and I'm definitely too old to sit in the mud watching some comedy.
Fantastic. Dankeschön.
Gern geschehen.
Tschüss.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest, and it's days like this. We get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically, in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
We're watching a crisis unfold in the UK, and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset, with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs. From scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
Welcome back, everybody. We got Bill Blaine in the house as the Nasdaq is about to go through 23,000. What a morning, Bill.
I'm looking at the US stocks and I'm figuring out, how is that possible? What's going on? Have they not seen the news? Now, I know you're going to say, yet another bear on the program. I'm not a bear. I'm a bond trader.
The bond trader can be the winner, but Joe didn't think so. Joe thinks that we could see up to 1 additional point of inflation, 3.5% in the US in the next 12 months, and that takes bond yields above 5%. Is that right?
I think that's distinctly possible. You know, the fact that we could well be heading into bond bear market if some of the worst outcomes of trade policy come true, that's very, very probable. And remember that if you end up with very high interest rates, that has a massive effect on the stock markets as well. It will take a lot of the froth out of the markets. Remember, Rich, in bonds there is truth.
Yes.
In stocks there are stories.
Stories and hopes. And there seems to be a lot of hope in there at the moment at 23 times earnings.
And to use another cliche, hope is never a good strategy.
What do we do then? What do we do? People sitting at home have got a lot of long positions. They've done very, very well on them. How do they protect themselves?
This is, we are heading towards a frothy top in markets. How frothy that top is really going to be a function of how bad the economics play out. Now, earlier this week, I was speaking at a conference and I was saying, well, look, Trump's actually pulled off a bit of a blinder here. He's pretty much managed to get the rest of the world to agree to 15% tariffs.
Yeah.
And there's been a lot of criticism of that, especially within the EU, for accepting a 15% tariff rate and zero tariffs on US exports. But, that's a pragmatic thing. It's better to have an agreement than to have no agreement. But then this morning, we've got the other side of that, where Trump has slapped on a 35% tariff on Canada and a 39% tariff on the Swiss. Now, come on, that's a really interesting axis of evil, Switzerland and Canada. Come on. But the effect is going to be it's going to be out of all proportion. This is what I was thinking about this morning in my daily comment, The Morning Porridge. And the first thing that struck me, I was actually going to go with another thing, which was about the costs of immigration this morning.
Okay.
But I decided to go with the Canada story because that's a problem for the UK. Because you got to remember that our King Charles, is also head of state of Canada.
Of course.
Now, I think it's very difficult for the King of Canada to be welcoming a man who's just declared economic war to come on a state visit in September. Now, I think the pragmatic answer is let's all keep smiling and let's not upset Donald Trump.
Yeah.
But you get to a stage where that begins to affect sentiment and mood. And remember, markets, especially stock markets, are all about sentiment and mood. There's nothing clever about markets. They're just a voting machine that weighs up what people are thinking. And if people are increasingly thinking that, these tariffs are really a bad idea, that begins to play on the market sentiment. Now, the reason that I was saying earlier this week that Trump's played a blinder is because we have seen, by and large, exporters to the US and US importers absorbing most of the costs of the tariffs.
Absolutely.
These have not been reflected in the costs that US consumers are paying. And that's a really good thing. And that leads us on to a totally different discussion, which is just how badly off US consumers are just now. I would describe them as pretty much tapped out. They've just, if you're a young person, tapped over, tapped out. I'm not sure, Rich. What would we say back in Edinburgh?
Well,
we'd say they're busted.
In a wee spot of bother because
what can they do? Let's just wander back into our usual language and stop putting on these silly English accents.
Yeah, exactly. This BBC,
received wisdom. Anyway, no, but the reality is that US consumers are in a really bad place just now. Trump's promise to them has been he's going to restore prosperity. But the reality is they're getting hit with massively higher medical costs. They're going to have to start paying back their student loans. We are seeing defaults starting to creep up in credit cards. And the first place you look is in the auto industry. Mm-hmm. Are they paying their car loans? And that number is beginning to creep up, the number of car loans that are in default. So American consumers don't have the money to cope with an inflationary impulse. And thus far, Trump has succeeded in avoiding that impulse hitting the nation. But the thing is, this trade war with Canada doesn't make much sense because the US auto industry relies on Canada for a large part of its parts, which are all going to get thumped. Not at the 35% rate. I'm just trying to check that just now.
Yeah, because they're in the agreement, aren't they?
Yeah, there's all kinds of trade agreements are never simple, which is why Trump has never signed a trade agreement. All these big announcements last week about, they've done the right thing by setting up bollocks they have. I mean, I can't say that on the TV
you say what you want, Bill Blade.
The reality is these are not trade agreements, these are trade outlines. And they're good. They are good. At the end of the day, let's get trade going again. But what we've seen with the Swiss and the Canadian announcement is just a reminder of how capricious Donald Trump is, and that we are not out of this period of uncertainty. Now, that then takes us back to the stock market, which you were originally asking about, because I think we're getting something of a top. How bad that top is, whether it's just another correction, and I suspect it will just be a correction, even less than the one that we saw in April, where we just get the market saying, okay, it's pushed a lot higher. You know, you were talking about the Amazon results earlier. I think that's really interesting because it's clear there's enormous amounts of money getting spent on AI across there. And the fact that Apple is the stock that's leading us higher this morning.
Yeah.
I mean, Apple just sells very expensive stuff that other people manufacture for them. They don't actually come up with anything new. The reason that I am an Apple addict, if you were to look around my office this morning, there is Apple everywhere. But that's because I grew up in a generation where Apple was new and exciting and innovative. I mean, they haven't done anything innovative for decades.
It's honestly one of my bugbears, Bill. Why Tim Cook is still in charge of that company. The man he's out of ideas, and it's time for him to go and let somebody come into Apple that can take this company forward.
I might introduce you to the head of Apple UK to have that discussion.
It's incredible. I mean, we should have Apple everything by now. It's the brand, like you say. I've got my my watch, my phone, my laptop. You know, if I should have Apple banking, I could be driving an Apple car. I should have an Apple, you know, the Vision Pro kind of thing. You know, it should be great and it should be easy to buy. Anyway, talk to me.
Yeah. That's another story for another day. Anyway,
Exactly.
What's the next thing? What have we got to look forward to?
Yeah, the earnings estimates post this quarter and starting to put in the estimates for the next quarter. Where do we go with these earnings estimates?
Okay, so that's a great question, Rich. I love it when you ask things like that. The market is high-fiving itself today because the earnings in this reporting season have been better than expected. I think it is. I think I quoted 80% as better than estimates, and someone else told me, no, the real number is only 73.5% better. It doesn't really make a difference. I mean, the fact is, earnings have exceeded expectations. But let us not forget that these expectations were set low because everyone anticipated a much higher damage to be done to the US economy by Liberation Day tariffs.
Yep.
And they haven't happened, and so the earnings have been better. The smart analysts are going to look at the coming quarter, which will start from October. We'll start to see the numbers coming out then. And again, they will be setting lower. And I do think that the fact that Trump's been able to get agreements on 10 to 15% with most nations will mean that the economic damage is limited. So you're still going to have that impulse driving the market, which is why I think that the coming correction isn't going to be a terribly deep one. Unless...
Ooh. Unless, yeah, talk to me. Tease us with the
unless is the no-see-em. You know, there's a great Scottish expression for a midgie, a horrible little biting insect that apparently the Romans brought to Scotland.
Is that right?
And they're so tiny that my granddad and my dad used to call them no-see-ems because they would bite you and you wouldn't know about it until the swelling came up. That's what happens in markets. I mean, other people call them black swans or things like that, but it's a no-see-em.
Yes.
It's something that happens, and it's often there in plain sight that suddenly impacts the market. And the one that I'm thinking about this morning, it just occurred to me as we were talking about, is this issue of what would happen if King Charles was to withdraw the invitation for Trump to come for a state visit. Trump would no doubt throw a wobbly. The UK would probably be slung on to 35% tariffs. There'd be all kinds of negativity in the market. And the rest of the world would watch and they'd go, he did a deal, he agreed a deal. The reason the British have done this is for perfectly acceptable reasons. And you just get another outburst of instability and uncertainty in markets. I suspect that will not happen. We'll find a way of that. Yeah. I've just received a message from one of my Canadian mates who says that the Canadians are all sitting in their hotel in Washington. Discussions are ongoing. Well, this is actually Trump playing a game. He's doing the old drama triangle thing.
And the tariffs don't come in for another 7 days, so in 5
No,
days'
they
time...
didn't. They kicked in last night, Rich.
Oh, sorry.
That's the really interesting thing. Everyone else gets 1 week to get their tariffs in place, but the Canadian ones kicked straight in, which is fascinating. And I thought one of the really funny things, is last night Trump was justifying this because of the amount of fentanyl being found coming over the northern border. Well, it turns out that since January, US Customs have seized the incredibly big tonnage of 19 kilograms of fentanyl. They are seizing 10 tons every day on the Mexican border.
Well, I don't know what you do with fentanyl, if you smoke it or you take it, but somebody is smoking something.
I've never even heard of the stuff.
On this S&P 500, because let's have a look at the EPS squiggles, this wonderful chart that we get from Yardeni. So there we're talking about 2026 EPS estimate of $301 per share. 2025 is 264. Like you say, that's come down from 280. So we've had a drop in estimates of about 7%. And the market's at all-time highs. If earnings estimates are coming down, aren't markets meant to go down as well, Bill?
Are you telling me that you think that US stocks might be overvalued?
I wouldn't tell anybody of such a thing.
Rich, I've been saying since the middle of the 2010s that the effect of quantitative easing, which was to make interest rates too low, that has an effect on relative values. If you set the base rate for the economy, the risk-free rate, the bond rate, as we call it, too low, then that has an effect in bringing down yields across every other asset class. So the real thing that happened during the QE era was a massive inflation in financial assets. Prices went up because yields came down.
Yep.
Now, that is what drove the phenomenal growth of the stock market. And all you need to do to see that is call up a chart showing US GDP. And what it will tell you is that the US economy doubled in size over the period 2010 to about 2024. Don't quote me in these numbers, but the trend that I'm quoting is roughly correct. So the economy doubled in size, but the value, the market cap of the S&P 500, guess what it did?
It's got to be 5x, well, 4x maybe.
5x.
Is it 5?
Yeah, there you go. Yeah. Now, you explain to me how over a 15-year period the economy doubles, but the stock market quintuples.
Oh, I can tell you. I can tell you very easily. It's because they made trillions of imaginary money, gave it to banks and said, off you go, leverage it as much as you like. And it all went into financial assets. So it's, this has got to come to an end at some point. I'm not sure what that is.
The only way that you could justify that kind of rise is that the dividends that companies are paying were up 5 times, but of course they're not. What we've seen is more speculative investment than ever before because of the overvaluation. Now, you mentioned banks there. Banks is the big thing I'm thinking about today. I'm having a conference call with one of my clients, and they want to have a chat about, the most famous Scottish bank in the world, the home for Scottish bank clerks. Everyone else calls it HSBC, but of course we know that it's at heart a Scottish bank.
Absolutely. I've never heard that, the home for Scottish bank clerks. Very good.
Yeah, that used to be the old name, the home for Scottish bank clerks, because, when I was at school back in Edinburgh about 5 billion years ago, they used to come around recruiting direct from the schools, and they'd tell you, come and become an international officer for the bank. You don't need to bother going to college. We'll teach you everything you need to know. And you'd be in some kind of officer's mess for the next 20 years as you went around the world learning all about banking and trade and how to do these things. And so HSBC had a particular ethos all of its own that was founded in these people. But then, of course, it had to compete in the real world. But when I was working for HSBC at the turn in the 2000s, the early 2000s, it was the biggest bank in the world by market cap.
Yeah.
And we were able to go off and do things like buy one of the biggest consumer businesses, subprime consumer businesses called Household in the States. And HSBC was in a roll. The intention was for it to become the biggest bank in Europe, the biggest bank in North America, and the biggest bank in Asia. Well, you take a look where it is today, where there's a massive cost cutting going on. They've abandoned the Tower of Gloom in Canary Wharf.
The Tower of Gloom.
Oh God, it was awful. Working in that building was one of the low points of my career, because I don't know where they got the paint from, but the British Navy must have run out of grey for their battleships, because that building was so grey and dull. But anyway, today you look where HSBC is in terms of, it's still a very good bank. It still does banking very well. But you look where it is in terms of, how do you cut a bank? How do you rescale it? It's just no longer a competitor on the global stage. And sadly, I feel that's something of a metaphor for the whole of the UK financial sector.
Most definitely. Right, Bill, we are watching markets as the S&P goes through the lows yet again, 6,282. We have bust that 23,000 level. To use Bill's phrase, the American consumer is bust. Well, now the NASDAQ has bust that 23,000 level. On the way lower, Vol now up 4%. We spoke about that earlier. When it starts to go, it really starts to go. How are the Americans going to deal with walking in and those retail customers losing money for the first time in a long time? Are some of them going to be losing money for the first time today? As we see Coinbase down 11, Amazon down 7, AMD down 4, NASDAQ down 3. Bill, where does it stop, or has it even started?
Well, the first thing I've got to say is I missed that Coinbase interview that you talked about. I've got to watch that, because I've actually invested in Coinbase myself. Not allowed to say that, of course.
This was the CFO.
I must look at that. Look, there is something going on. I think if this was a purely institutional market, we would have seen a correction before.
Exactly.
We know that a lot of institutions had gone short the market. They were brought back into place by the power of retail investors.
I'm just going to quickly try and get a picture up for you, because, as you say, if this was a normal market back in our day, it would have already rolled over. But it's not anymore, is it? It's a CTA, an algorithm-driven momentum market. And those are very different, because it takes us to new levels that no human would ever consider buying at. But the computers don't care. The algorithms don't care. And
retail follow them.
And retail get very excited and very greedy. And we can see this because we've got the proof in the pudding that my good friend Andrew Hart has been good enough to send. Nomura's estimate of global CTA positioning is in the 100th percentile. They are as long as they get. These are the machines that throw this S&P 500 around. So I can see on the chat, You're already talking about buying the dip. You got 100% of long position to sell if you are in that CTA. And then Schwab's client survey, 57% bullish, the highest reading going back to 2017. What happened in January 2018? We saw a very quick turn. We saw volatility double, and we saw the market drop 8% in a day. So just be careful. I'm not saying don't buy the dip. I'm saying Don't bet the house on it, and be careful with your leverage there.
I am going to put my contrarian hat on.
Tell us.
I'm more and more convinced by that chart you just see me, which is great, that what I predict is some kind of a deeper correction than just a day dip. I mean, you want to go playing by the dips and market timing, your call. But one of Blaine's key market mantras, it is better to miss the last 5% of a rally than to catch 100% of a crash.
I think that is a great way to finish off our live shows for the week. Bill, it's been an absolute pleasure. Have a grand weekend up there. You're going to have a wee whiskey for me?
No, I start my holiday today. Nipping up to Wales for a friend's birthday, and then we are off sailing for a couple of weeks. Now, I'm going to be writing the porridge intermittently. I'm hoping to join you guys next week, and you can tell me what's going on in markets, because I want to prove that Starlink works from the boat.
Oh, fantastic. Oh, that will be a good test for us, for sure, and for Elon.
Yeah. I mean, years and years ago, I did manage to use a satellite phone to trade treasuries from the middle of the Irish Sea during the Fastnet race. And I think we made an $800 profit on the trade. The problem was that the satellite time cost $1,300.
Oh, no. Wow. Okay. Yeah, before the cost came down there.
Yeah.
Thank you.
I better let you get on with the day.
This is brilliant. And just a reminder, what a wonderful hour. Joe and Bill Blaine back to back. If you have enjoyed it, please give us the thumbs up and please give us the subscribe if you haven't subscribed already. That will be a wonderful way for us to finish the week. Now on Monday, we've got some real exciting stuff. So Monday coming up is myself and Beachy through. Garth McKenzie's back. We got Expert Edge with Garth McKenzie at 8:35, and then there's a lot of me on there. Have we not got Angeline back on Monday? Is she taking another day off? Is she off the whole week? Stop. That's it. I'm done. Bill, enjoy your weekend. Everyone else, enjoy your weekend.
I will do.
I'm going on strike now. We might be back, we might not. Let's see what the non-farm payroll does. If the market's down another %, I'll think about coming back in on Monday. Welcome back, welcome back. I am very happy to have Tom Price in the building.
Thank you.
So just to give you a bit of background, Tom and I worked together at Macquarie. He was the big boss, the head of commodities research.
Yeah.
And if you're head of commodities research at Macquarie, then
you're on a plane all the time, just talking to strangers. Yeah.
Give us a little bit of an introduction to how you ended up in that position to start with. And
just a series of bad decisions, thanks, Richard. So, but yeah, no, it's just the last bank I worked at, currently at Panmure Liberum, doing more or less the same thing, just powerful, deep, insightful commodity research.
Brilliant. Yeah. And then did you come from a mining background? Were you down there underground?
No, I did some underground time. I used to be a geologist, but my specialty was exploration geology. So I used to go out there and look for stuff. Yeah.
Right. And then that was back over in Oz?
Yeah, mainly in Australia, but spent some time in dodgy places like Central Asia, Russia, just looking for stuff there too. Yeah. I know, it's pretty exciting. Yeah.
Now, what excites you about the sector?
Well, it's you have to be good at macro and thinking big, because the sector I looked at, global commodities, so base metals, precious metals, bulks and stuff, they just get tortured and tossed around by a casual throwaway statement by, I don't know, a US president. And so it really keeps you on your toes. You've got to be on it all the time.
And what's the key to understanding commodities as a whole, would you say?
I generally tell people you've got to know who the big buyers of a commodity are. or is in China's case, and who the big producers are. And every market, even though broadly they sit in the commodity space, they're all structured differently. And so you've got to understand what those structures are. Does it favour the producers? Does it favour the buyers of those commodities? And try to figure out which element of each market dominates price action.
Right. So demand supply, really working out where the imbalances are, oversupply. What would you put them into buckets at the moment, do you think? Or?
Well, there is some market. The bucket I would toss some of those markets into, if we're talking buckets here, is which commodities does China desperately need to keep the economy functioning?
Still that's what we were playing in 2007.
Well, it still matters. They consume 40 to 70% of all commodities supply, but there's some commodities they have no choice but to go overseas for. So, world's biggest aluminium producer, but they actually need to import most of their bauxite. Copper, 70 to 80% of their copper units are imported, and iron ore heavily dependent on imports, and particularly from beautiful country that I call Australia, Richard. So they're the three commodities.
You'd be in a bit of a mess without China buying your iron ore, wouldn't you?
We'd still be playing cricket and doing barbecues. It's not a big deal. And maybe playing rugby, for example, stuff like that.
Yeah. Now, which one would you like to go into first? If we're going to talk about copper, iron ore,
go for it.
If we start with a couple of commodities you think are particularly interesting at the moment.
Well, I mentioned bauxite, copper, and iron ore. Really, copper and iron ore dominate they're the dominant drivers of equities that most people are invested in. So think of big stocks like Rio, BHP, Anglo's, Glencore. Vale, all of those have, including Vale, have iron ore and copper exposure. So most of the time I spend with clients, I'm always talking about those two markets.
Okay.
And so I think, that's probably where you need to focus on. So
that's us showing high-grade copper. Would you rather I get LME up, or is that a...
I've never... high-grade copper will do. The price action will be exactly the same. And crikey, that is going vertical. I wonder what's driving that one, Richard.
Yeah.
Probably a US price.
Almost as if somebody's interfering in the global dynamics.
That's a good word, interfering. It's amazing what a 50% tariff will do to a trade. And over the last 12 months, and it's not just the last few weeks since the US president decided to load up 50% tariffs, this market's been pricing a 50% tariff or something big for months, and we've actually seen a big transfer of copper into the US to try to close that arbitrage, and it hasn't really closed yet.
What's kind of percentage when people talk about, you need a lot of copper for electric vehicles, for AI data centers? If I'm building a data center, is it a tiny cost so I don't really care?
That's the fact that you've asked the question that way tells me that's exactly right. If you're building a giant building, some of the cost elements that make up that thing are trivial compared to the cost of the construction work. So a data center builder will be not entirely indifferent to copper, but it won't be a big factor.
Right.
Land access, government support and subsidies for the program of building it, so on, they're far more important. They probably spend more time on that. And also, can they control those cost elements? Probably not. And also the time frame, they probably build over 3 to 5 years, so they're not really concerned about what the copper price is doing right now.
Yeah. What's the smart trade then on copper at the moment?
Well, we're famously bears on copper in the market. Not many people can get away with doing meetings with clients with that view, but they are intrigued to see us. It's like catching up with a nut job in the street who's thinking about a downside risk to this market. In actual fact, bulls and bears have been completely wrong for 3 or 4 years, since lockdown actually, because the price has basically traded sideways.
That's it, yeah. Goldman this is the time, 2022, you got to buy copper now. It's going to the moon.
Yeah, Goldman's some really powerful research there, mainly pushed by their desk. But they were talking about a super cycle thesis, which we thought was hilarious because it wasn't a super cycle. It was just a good old-fashioned inflation trade after lockdown.
Yeah.
But it's actually been trading at about $9,000 plus or minus 10% for the last 3 or 4 years, even though we've been bearish. and completely wrong, not surprising for a sell-side analyst. And the only thing that makes me sleep at night is the bulls are wrong too, because of that sideways trade. And it's possible it may carry on doing that. And that's one of the extraordinary things about the copper trade. There is a stunning amount of generalist capital that's been parked in the copper space. And so it tends to respond mainly to macro themes.
And then what about the mining stocks of the copper producers? Obviously, Anglo's, BHP tried to come and grab it.
Yep. So that was an interesting effort. 3 bids turned down. So, and then Anglo's has proceeded to dismantle itself. And what it's trying to do is get rid of all of what it regards as non-core assets, perhaps. So coal, it's just spun off the Anglo-Platts division into Volterra. It's now considering De Beers. What's it trying to do? It's trying to be a copper-rich equity, which is regarded as very appealing to investors at the moment because it's a green input for greening the planet. So,
and are there copper assets really impressive, or there's big growth potential? Or
it's got growth and it's got high quality assets, but the superstar asset in the Anglo's stable is Quellaveco. So it's a huge South American operation. When we're looking at probably a 4 to 6 sort of level mine on planet Earth, and that's a company driver if they can, carry on developing that thing. So big copper assets takes staggering amounts of money, long lead times to get into the market, and they're doing a pretty good job.
Yeah. So. And now that they've cleaned everything up, if De Beers, they also managed to divest that, is it just a bite-sized chunk for a BHP or Glencore or?
Yeah, it's only one company can clean up Anglo's, and that's probably Anglo's. And I've got to say they're doing a really good job. So, but eventually they're going to create an entity that will be enormously appealing for a major to engage. So, and the ones that investors keep sort of flagging to us is BHP, obviously, because they've already had a go at it.
Yeah.
Glencore, although it's just spent $7 billion on coal assets out of tech, so maybe it'll struggle.
But that was a reversal, wasn't it?
Yeah, that's right. Yeah. We hate coal. Actually, we love coal. Everyone.
Take my money.
Turns out we like cash. And poor Glencore's struggling with, very weak coal prices on met and thermal. It's the biggest exporter of both. So it's going to struggle, I think, for a bit longer. But Rio, Freeport, all of these are candidates for taking out a copper-rich sort of company like Anglo. So it'll be interesting to see that play out if it happens.
Yeah. Let's move on to iron ore then.
Okay, iron ore. We can talk about gold too, see where Greatland's going to go. Iron ore. So what month is it? July. I start getting bearish about now. So I'm a seasonal junkie, as they say. I think about seasonal drivers for this trade because the iron ore steel supply chain centred on China is profoundly seasonal. So what it does is China goes crazy bringing in raw materials for their steel industry, including iron ore, after Chinese New Year through to the centre of the year. And then about July, August, they start rationalising their production rate, start thinking about maintenance programs as they enter the winter period. And usually the turning point's about September, October. But this year we've got an exciting new bear theme to talk about, and that is China's government is actually considering capping production because they see a surplus in their local market, and so that of steel. Yeah. So China imports, as I said, 80% of their iron ore units, and so that's going to sort of retard the seaborne prices perhaps by fourth quarter.
Right. And then, so this leads into our beautiful drawing there that you've sketched so well. We're going to hold that up. Yeah, brilliant. Yeah. There we go. So China's seasonality and...
they come out of winter and Chinese New Year, and that period's a great transition for anyone who's invested in Rio, BHP, FMG, Vale. Anglo's also has the Minas Rio assets in Brazil. And this is what I call the blue water period, very quiet period between May and October. So we're in the middle of that. And then we go for the downswing. Now, China's government is acutely aware of this dynamic, mainly because they get our research. But I've spent a lot of time with Chinese mills and they talk about this. And this is a period where generally they try to clean up their capacity and tighten up their supply chains, and they basically draw down inventories, and that has a big negative impact on the iron ore trade. And generally, the best time to trade this is to basically buy iron ore exposure around November, or when PAMU or Liberum Research comes out and tells you to, and then sell around here. So that's the trade there. Buy here, sell there.
And we're right at the peak just now.
Yeah, we're in this period here, so downswing. And production caps will have a big impact. This industry is super lean and highly responsive to government policy. So when they're told to act, they do act. And that's something worth tracking. So the big iron ore producers are aware of this too. So
yeah.
They get our research as well.
In terms of iron ore, Rios is obviously the king.
It is. It's the superstar producer.
Oh, sorry. And we've got the chart here, and you can see the cyclicality.
Yeah, make
the
up your own
cycles.
word. That's fine. Call it cycles. Save yourself.
There's certainly cycles there, isn't there?
Yeah, the transition to prices is not clean. It's quite messy, and the reason for that is the mills have amazing capability of switching between their different iron ore options. So they don't just get fines; they get lump and pellet, and they also pick up scrap, and that tends to neutralise the price response to the seasonal flows underneath. But every now and then, they just can't help themselves, particularly if there's stimulus or some sort of positive outlook that is exogenous to China, and they will buy aggressively, and that will report through the price. But that's not that sort of year. They're very subdued. They're trying to manage their costs, and they're a bit nervous about this production cap that the government keeps talking about.
Okay. So, yeah, sorry, to go on to the stocks, that puts a bit of pressure on Rios, doesn't it?
Yeah, it does. So, and BHP and FMG in Australia, they're the main sources of iron ore for China. So, so China gets most of their ore from Australia and the extra bit from Vale, and they get nervous about this time of year. So, so this is, it was interesting. Their last quarterly update a couple of weeks ago. They did express surprise at how well China's economy's held up. They sort of praised China's ability to switch into the export trade because their domestic market wasn't strong, and to be able to manage the tariff war with the US. But they weren't bullish. I think they're expecting some more pressure to come on their trade, so they're a bit worried about that.
We've got a beautiful chart of Rios there. Down this morning because they reported soft numbers.
Yes.
Let's say, but I guess our traders are particularly they love trading Rios normally as a buy around these levels because it runs through that kind of support levels normally in those mid-40s.
Yeah, so I'm talking about fundamental drivers for iron ore and rather than the equities. But the equities have been under a huge amount of pressure all year because they're getting hit by the tariff theme. So investors are going, thanks for the seasonal charts, Tom, love the drawing, but I'm really worried that China's steel-bearing stuff to the world is just going to get taken out by this tariff conflict. So I'm just going to take some money out of the big equities and just wait. And so we've seen all of them come under a lot of pressure during the course of the year. So now we're starting to see some of the metrics get to some interesting levels. And we're getting calls from value investors that are saying, is this a good time to sort of get involved? And I said, okay, well, maybe just wait a couple of more months. So a better entry point's the end of the year, we think.
Yeah.
So.
Incredible. Right, so that's BHP, Rios, we've looked at Anglos, Antos. I guess we can't be bullish if we're bearish on copper.
Yeah, the most popular pure play equity with pure copper exposure. So Antos and Freeport. Freeport's just big, slow moving, and Antos is a bit more interesting. All their assets most of their assets in Chile, and it's the exciting way to play the copper space. And they've been mining copper for decades. They are technically very competent, and they're very good at messaging the market. So it's if you want a nice clean way to get exposure, that's the popular one to go for.
And have they still got the big family owners?
Yes. So it's still big chunky family ownership. that dates back 100 years, started off in rail, ended up in copper, and they're not going anywhere fast.
Yeah.
So they're quite happy where they are. And I think we've got a hold on them at the moment, the stock. But yeah, it's hard to switch to a buy given that we're bears on copper, so we'll probably just hold that position for a bit longer.
Any stocks that you're particularly interested in at the moment or think are worth a look?
Well, I tend to look at the big stocks we've just been talking about because I'm a macro guy, and decisions by the big mining companies obviously are very important to the main commodity flows. So but they're the ones that we sort of focus on at the moment.
Let's have a look at the commodities then. And yes, we've got platinum on the system. That's suddenly out of nowhere found some life.
Absolutely. So I've just been marketing in South Africa. So and we're bulls on PGMs. So we like platinum, palladium, rhodium. And we're also very confused bulls at the moment because the calls work, but for reasons we can't quite understand. So we would agree with you. It all started to happen on Platinum Week in London, middle of May. So we were hanging out with PGM gurus, WPIC, the Oxford crowd, and also the Anglo-Plats mob, having lunch with them, drinking, laughing, saying, yeah, the price is going to lift. The price is lifting, and over the next few days, it started to lurch higher for no obvious reason. Looked through our network of contacts, didn't find anyone who was sort of restocking because that was the famous driver everyone was holding out for.
Right.
And in the last couple of months, it's bolted on 30 to 50% to very subdued price action that lasted for years on nothing in particular still. Yeah. And so we're still trying to come to terms with that.
I think it was because I sold my palladium.
Is really
that was the final.
It's a
resistance.
Inventory poor market. So thanks for releasing that stuff. So what are you doing with the garage space now?
It's
the catalyst, I think, was the Volterra spin-off. I'm convinced of that.
Didn't it? Yeah.
Because in the days after the spin-off, we were getting lots of incoming queries on the state of the PGM market, what PGM stood for. So obviously we're dealing with generalists when they're asking that question. What's PMG, Tom? No, it's PGM. And then you give...
What's Procter & Gamble got to do with it?
So there's a lot of 101 sort of chats for a few days from the US and here in the UK because the listing was on the LSE. So lots of intrigue. And I think people have basically positioned in an illiquid market, and that it wouldn't have taken much to actually make the prices pop, I think.
Right. So. And yeah, as you say, they'd been depressed for so long or capped.
Yeah,
I guess.
Yeah, thoroughly capped. And but the fundamentals of this trade are extraordinarily tight. No one invests in new supply. Most of the supply comes from essentially two deposits, Norilsk, which we're big question mark over whether we can access that supply. We're still getting Russian PGMs, but who knows what would happen in the future. And the Mariinsky Reef in South Africa, and no one's really growing supply for one reason or another.
Yeah.
And it turns out we actually need internal combustion engines with autocats for a bit longer, maybe a few more decades. And EVs aren't going to save us. And so demands hasn't really changed a great deal. So that's a winning combination for price upside.
Yeah.
But the prices haven't responded to that until May. And now we've got a very interesting market in play.
Right, so that's gold. Yeah, we mentioned we were going to have a look at gold.
Gold, yes. So extraordinary price lift over the last 12 to 18 months. It's now sitting comfortably at about 3,300 and holding. So it's actually been range trading. There we go. You can see the range there since the end of Q1. Very tight range. I think it's 3,300 plus or minus 3%. And what that's telling me is all the bull factors are thoroughly priced in and understood by the market.
Right.
What are those bull factors? Most of them are short-term drivers. So we've got a rate cut cycle theoretically still in play. We're going to find out whether it is or not this week. But the other factors include deterioration in global trade, That was actually happening since Russia invaded Ukraine. So a lot of confusion and uncertainty between major players around the world.
Yeah.
And then that's been compounded by the fact that Trump's rolling out tariffs. So there's a lot of uncertainty there, and so people buy more gold. But you've got war themes. So we keep seeing it pop up on major incursions or events. So Israel versus everyone in the Middle East, Russia versus Ukraine, China's Taiwan confrontation, Cambodia, Thailand. Oh my God, it's just lots of themes there. Buy more gold. But the one driver that I think is enduring and extremely bullish and difficult to quantify is China's willingness to keep buying metal from abroad and storing it in a back room somewhere. And I think they have, it's quite clear to me anyway, that they've got a plan to back the renminbi and perhaps offer a reserve currency to the world. And they need to back it with gold. And so that's a theme that's probably worth tracking. So the World Gold Council tracks the reserve positions of all the countries. And I think China's number 6 now, with about 2,500 tonnes of gold, versus the US number 1 at 8,000. So they want to go big in gold. And so if you're a gold bug, that's a very exciting theme.
And that is, that's the longest of long-term plans, I guess, because how...
No one does long-term plans better than the Chinese. Yeah. And that's decades long, I think. So maybe we should get comfortable with a higher gold price than what we're forecasting. Yeah. So that's probably the biggest upside risk to our forecast at the moment.
Great. Smaller ones like aluminium, nickel.
So the Ali trade was knocked about last year by supply chain themes. So we had multiple refinery failures in Australia or closures. So Alcoa had some Western Australian assets. One of them was shut down for cost reasons. And Rio, in their Queensland asset refinery there, they had power issues. So we saw about a couple of % of global alumina, that's the oxide used as a feedstock for aluminium smelters, shut down. But the real driver was Guinea, sourced at 25% of the world's bauxite, the raw material that gets converted into oxide and then to aluminium. They just randomly decided to shut down exports, and that starved the market of another couple of %. So my modelling went massively into deficit, and the entire supply chain, bauxite, alumina and aluminium prices all lifted. It's all calmed down a little bit this year. So we're seeing the bauxite and alumina prices stabilise, but now the aluminium price has been knocked about by these tariff themes. So, it's a very exciting time to cover that space. So, but in terms of equity thoughts, Alcoa, Rio Tinto is a big producer, Rusal, if you can trade in Russian stuff, and Chalco in Asia. So they've all been beneficiaries of these various and evolving drivers for aluminium. So think of a price of about 2,500 to 2,800. That's the range the aluminium price is going to hold in.
Now, before we let you go back to the real world, if we get a scenario where there is peace, Russia and Ukraine, and gradually, backed by Trump, Russia's allowed to become part of commodity world again, what are the kind of smart things to look at?
That's a good question. So the popular view is energy markets will collapse because you get this flood of coal, oil and gas. So pre-war, Russia was the source of 10 to 15% of all those three commodities. And so production would be cranked up because they're connected back into the world and we'd be overwhelmed with it. Not true. In actual fact, the supply rate of Russian coal, oil and gas to the world hasn't really changed a great deal. In fact, for coal and oil, it lifted and went into their dark fleets. Gas is probably the only one that was truly constrained because the infrastructure pipeline into Europe couldn't be switched physically anywhere else, and they couldn't really crank up their LNG capacity. So maybe we'll see a resurgence there. But the EU is quite determined to shut down pipeline forever. They're talking among themselves and they're trying to terminate it forever in 2027. So maybe the lack of Russian gas will keep gas prices across the world through the LNG trade higher for longer. So that's the one we're probably thinking will be the bull case. All the metals trades, copper, PGMs, they've constantly been delivered into, and aluminium, sorry, they've been constantly delivered into the world ever since the war started. It's never really been effectively shut down. So I don't think that's going to change much either. So the answer to your question is not a big change, perhaps a little bit of bullishness around gas. Yeah.
Amazon earnings are out. Apple's up next. It is Thursday, July 31st, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak's in San Francisco. No Radigan today. He'll be back with us on Monday. But we're here for now to take you through the futures market close at 5 Eastern, 4 Central. If you're on the platform Tasty Live, nope, that's the website, tastylive.com. The website's Tasty Trade. Either way, welcome to the show. Come over to YouTube. Tell us what you're trading, what you think of this action. As Sunnagoon said, was my bouncy, boyish joyousness yesterday the sign of the top? Maybe indeed. The NASDAQ did rally up here today, only for a little while before it came crashing back in. We have a Microsoft and Meta earnings jubilation overnight, adding more market cap than, say, the entirety of a Costco or a Netflix, as we see, is eradicated, and then some today, where we do ultimately get a move and close below yesterday's low. Ooh, so spooky. An engulfing bar. Key reversal at the end of July, heading into the seasonally most bullish time of the year for volatility. Ilya, Microsoft and Meta did make a ton of money, but the market today decides to take some profits. We see a NASDAQ surge to new all-time highs and close below yesterday's low, which is among the worst things that could happen. If you are a bull and have been riding this Icarus into the sun, the wings have, technically speaking, perhaps melted off at this point in time. But we do have Amazon out here after hours. And before, Ilya, we go into this price action for today, I do want to go to the chart. Those earnings are better than expected across the board, which is what makes this reaction, Ilya, as you pointed out, all the more interesting. They beat on EPS, $1.68 versus $1.33 expected. That's a 33% beat. Their revenue is $167.7 billion versus $162 billion expected. Another fantastic beat. The guidance for Q3, the high end was $173 billion. They've guided for $174 to $179 billion. And AWS, which contains their AI efforts, $30.9 billion, 17.5% growth. Ilya, even Amazon here with its strong earnings in the mirror and reasonable growth expectations moving forward, the market is not running with this either, despite bidding it higher all day. We await Apple in a few moments' time, not just yet. But as a bear's bear, as someone tweeted at me today, you were probably feeling really good.
As we were talking about those spikes on the Meta earnings and the Microsoft earnings exactly 24 hours ago now on yesterday's show, my concern with that exuberance was that what happened earlier in the day was the market's displeasure with the Fed, and the exuberance was coming on the back of catalysts that were perhaps short-lived. Those earnings were undeniably impressive, and we didn't learn in them anything that the markets hadn't known. What we learned was perhaps that the forecasts were woefully inadequate, but that was just about it. And what I was concerned about was that the story with the Fed was a bigger story, and that we had to be careful before we over-extrapolated a move in absent liquidity before the Asia Open even got underway. And indeed, things held up. They held up in Asia, they held up in Europe for the most part. And then when the US market came in, the price action told you very clearly what they thought. And the whole thing caved in on itself. So this was exactly the thing that I wouldn't say I knew that it was going to happen. Of course I didn't. Nobody could. I was concerned that it might. Because the price action around the Fed and the remaining event risk for the week really did look potent. And of course, the event risk is relevant. So what the markets are telling us here, seemingly, is that good news is unable to impress. And that is more bearish than if the markets were falling on bad news. And that should be a point of concern for risk sentiment all around.
Amazon here, 228 now, right after hours. That action today, the NASDAQ, very brutal. You were asking me how hopefully I got out of my stuff. Partially, over the course of the day, as I was talking with Nick, it's funny, I sent Nick a message this morning at 10:12 a.m. Eastern time, and I said, this thing is either going to close at all-time highs or we're going to close red today. And that seemed nuts at the time. But the read I was getting on the tape was that you were seeing the Russell fail in certain areas. We can go over to that 15-minute chart just to show.
That thing has been heavy as a rock, obviously, despite the tech earnings where it really couldn't benefit.
10:15 this morning is basically 2240 in the Russell. Why there? Why at that point in time? I would go down to the daily chart, the 4-hour time frame here. And this morning we had broken out of a flag and we were trying to get back into it. So if the Russell of all things could get back into its flag, then surely the NASDAQ and the S&P would be okay. That obviously wasn't the case. So we have a turn lower here, which now potentially we do need to consider, as Tom was suggesting, are the bears in control now? Is this a potential marking for a top? We do have tariffs going into play tomorrow, Ilya.
Maybe.
Do have non-farm payrolls potentially coming out tomorrow morning. Well, they're definitely coming out tomorrow morning, but that is potentially something that could be a catalyst in this market as well. We're still digesting the Fed. Are we for the stock market at least, are we still in a good news is good news world, or is good news bad news now because the Fed won't have an excuse to cut rates? I'm trying to figure out what the thematic narrative is on that lens after this week. I think we're going to have to think about it for a few more days once we see an FP.
Yeah. I mean, in my mind, it's kind of neither. It's middling data is the worst for risk sentiment. Because I think the markets very clearly are telling you that they want these rate cuts. There's just no question. The markets are also seeing that those rate cuts aren't going to happen near term. I mean, just look at what the pricing is for Fed funds futures for next year. We're out to 83 basis points. The markets see at least 3 cuts, and they're inching closer to 4. What we see from the Fed, obviously, is only a single rate cut that they've forecasted in June. Obviously, take that with a grain of salt. They're probably half-hearted on the 50 basis points that they projected then for this year, if you hear them yesterday. And the markets, obviously, now hearing that loud and clear. You can see it in the dollar, certainly, where the markets only have 1 cut, maybe, for the remainder of this year. We're out to 29 basis points. That's making now September look unlikely by about a 40-60 spread. 60% chance rates actually don't come down in September.
That was perhaps one of the shocking developments of today's market. Post PCE, we have a market that's saying the odds of a September cut are less likely.
That's right. Well, and with that, the worst thing that seems to stand here in the way of markets is jobs data that's weak enough to keep their desire for rate cuts alive, but strong enough to give the Fed cover to delay. And that's probably the worst of all possible outcomes, and also the likeliest of outcomes. Because if you look at the expectations, we're looking for 110K. That's down from 147. It's slower, but it's not catastrophic. It's not anything that's going to get the Fed to go, oh my God, emergency meeting, or oh my God, we need to sound so dovish from here that there is no question about September. And maybe we'll even go big. You would need a catastrophically weak number. You would need something in the double digits, maybe, with a potent rise in the jobless rate. It's already expected to go up, so that bar is high. It's expected to go up from 4.1 to 4.2. If we spike to 4.3, okay, maybe you might start to stir some hope in the markets. But now, clearly, the market is saying there's a slowdown coming because of the exchange rate in rate cuts from this year going away to rate cuts next year going up by a greater amount. And the markets are very clearly saying here, look, we're not going to be impressed with AI capex. We're not going to be impressed with Amazon earnings. We see a growth risk and we want these cuts. So if you get a number that lets the Fed off the hook on that, sort of in line with expectations, but doesn't tell you, listen, maybe you don't need rate cuts because the economy is fine, that's the worst of all possible worlds.
We're still waiting on these Apple earnings. As soon as they come out, I will relay them over here and we'll go over those Apple charts themselves. Ilya, even though the NASDAQ itself had the benefit of those Meta and Microsoft earnings, you would argue that perhaps it would be a little bit weaker here today otherwise. Even so, the Russell is the biggest loser to the downside, and we're starting to get into a place where if support were to be found, this would be a pretty darn good place to find it. In this current environment, if people want to be bullish, how are they structuring their trades? Are they doing this on like a day-to-day basis and kind of just dipping their toes in the water to see what they're doing from pull to pull, 9 a.m. to 4 p.m.? If you're bearish, do you give yourself a little bit more breathing room? How would you approach this? Because I'm thinking about whether or not how my approach has been for the past few weeks is still viable, which is to say that basically buy NASDAQ calls that are at the money, slightly out of the money, call spreads, and then look long S&P 500 puts at the 45-60 DTE window, if only to hedge off some of that risk. Today's action does kind of scare me. It kind of is like the worst possible thing that could happen after Microsoft and Meta earnings.
Yeah. I mean, I think at this point, you have to listen to the price action first and foremost. And what the price action is telling you today is that the market is shrugging off what a month ago would be unmitigated good news. And when you start this from the premise that you began this week with an upside gap after the world's most important growth engines, at least two of them, the US and the EU, finally reached a trade deal and took that uncertainty off the board. This is most of the world's end demand. If China is the middle step and the third engine in this sequence that really hold up global growth, China is the middle of the global supply chain. Europe and the US are end demand. That's the consumption that keeps everything going. And you got a trade deal there. That is an immensely positive development for global growth. And we're down on the week across every major stock index. So that was a tell early. The Meta and the Microsoft earnings being a flop, despite having lifted those stocks. I mean, Meta is up almost 12%. It's not like the market doesn't think the data was good. It's not like the market perceived some sort of a tarnish in the results. No, they were a complete positive as far as the markets were concerned. And that could not hold up overall sentiment. I think at this point, the market is telling you very clearly that there is a tendency here emerging towards some kind of distribution. And so while you don't want to run in front of a market that fundamentally doesn't like going down, the U.S. equity market is generally that way, and I would argue equity markets are that way in general. They're biased. When they do go, they go because it becomes a fire set. And so looking at the situation now, I think you look at the Russell, you're directly at support at about 2210 or so. It's probably not attractive to be a seller right here, but you get a breach of this support and you might have an avalanche underneath it. It's a similar story with the S&P, where if you're looking at the September contract, then 63.30, 63.45, something like this, former range resistance turned support, is now very much under fire. You get through that, again, danger. If you look at the NASDAQ, you have what is a very scary looking engulfing candle on the daily chart at this point. And you have very little defense. You have something maybe around 23,000, something else maybe around 22,800, something like this. But at this point, you're very much looking like a top is a live risk. And again, you're near, in the near term, former resistance turned support. So it's probably not the greatest risk reward to lay out aggressive shorts. But if ever there was a time to look at vol sub 20 across all of these things and say, all of them, the NASDAQ is probably the one with the most bearish signaling and the best risk reward relative to immediate support levels. If I'm looking to sort of consider the possibility that maybe sentiment has finally peaked, you can buy put verticals very cheap here. And you could introduce duration into those put verticals that helps to buffer you from near-term volatility and still gives you excellent risk reward if something asymmetric occurs. And ultimately, if you have to let it expire worthless because the stock market doesn't care and powers higher, and you take a loss of 1 to 2% of equity, so be it.
The key development for me is the fact that the NASDAQ lost 23,440 or so. We had the pivot highs here over the past week. We break out, we hold that support. We got the big rally up there. Just for what it's worth, this range, 23,100, 23,440, that's 330 points, 330 on top of 440 gives you what, 770?
Mm-hmm.
So last night we hit a high of 23,845. The measured move technically completed overnight before we pull back in. Now that we lose 23,440 again, support comes in back at the former swing highs in the short-term basis. You have that low intraday on July 22nd at 23,108. I called it 23,10.
Yeah.
Okay, so we have something.
That's about where I've got it.
We have structurally. That's to work with here for the S&P. It's a similar setup. It probably means you got another 30 or 40 points to the downside, 0.5% or so before you start to find some support. But the big picture, Ilya, is right now, as we reconstituted a few days ago, if this is indeed the trend that we've been in for the past several months, going back to just around the time that the US and China agreed to a truce in Geneva in May, we've been bumping into the top side of this channel for some time. And this uptrend that we've been in since May, a 3% pullback from here gets you close to 6,200. And then at that point, you'd have been more than 3% off the highs. And you can make the assumption, okay, we now had a 3 to 5% pullback. Is this something I'm interested in buying the dip on? And when you get there, maybe it's mid to late August and you have yourself looking at September. And if you start to break down from there, then you have your September spook, as one usually does. But taking this methodical right now, I think, is the most important thing. Look at how much money some of these tech companies are making. I think the growth scare, though, is the big point. Now, I don't know if it's materializing. I want to just be clear about that, because if you're looking at the data are still very muddled. You can't ignore the fact that third quarter GDP tracking began today, Ilya, and the Atlanta Fed, which, to give them their accolades, their flowers, they had a 2.9% expectation for 2Q.
The Atlanta
Q3.
Fed really nailed it here.
Yeah, the Atlanta Fed was really nailing it. 2.3% is now their third quarter. So they're not saying that, like, okay, second quarter was just an adjustment. Maybe there's still adjustments happening because of government spending and exports, imports, tariffs. But they see underlying growth at least holding up for now still.
Mm-hmm.
I guess that begs the question. I want to go over to Apple real quick here, because I see that we're talking through things. Apple, is this up a little bit? Looks like it's up a touch, actually. That might be nice. Directionally wrong on both, Chris. Good assessment. Apple earnings. Let's see. Maybe not. No, I guess I haven't seen anything.
No.
Just the market getting a little jumpy. Okay, 4 more minutes. Non-farm payrolls tomorrow.
Yes.
Tramal and I were speaking. He thinks that this is going to be a decent enough report. It's not going to bother the market. Tom was a little surprised when he saw that the implied move on ES through the end of the day tomorrow is basically 50 points in either direction.
Mm-hmm.
That's not necessarily what we've seen going into recent non-farm payroll reports. It's been 27 to 30. Why do you think the market is giving extra weight to tomorrow's report?
Well, let's do just a little bit of sequencing. What have we seen all week? Fed rate cut odds have diminished, and the Fed endorsed that idea for this year. They have likewise grown for next year because the markets want the cuts. They think the cuts are necessary, and they don't appreciate this delay. That they don't appreciate the delay tells you they see some reason that there is concern about growth. And frankly, the second quarter GDP data doesn't do much to dispel that idea, despite the headline number of 3%. Because once you strip out all of those distortions for imports going from surging to nothing, inventories starting to come down and pull down investment numbers, because we're finally starting to spend out of those inventories that were front-loaded in the first quarter. By the way, we're not refilling them at the higher prices. That tells you what wholesalers think about demand. But most importantly, we saw the weakest 6 months of household consumption this year since the first 6 months of 2020, the COVID recession. And that's 68% of the economy. So the markets were validated in thinking, you know what, I think, or we think there's a growth risk here that's mounting. Because that's the part that matters when you take all of the noise out of the equation. So the markets want these cuts. We have since gotten a spate of relatively good corporate news, and the markets plainly don't care. But for episodic jumps, as we just saw, and as we just talked about, Meta, Microsoft, even Amazon. That one couldn't even manage an episodic jump. So when we look at all of this together, we end up with the idea that the markets are thinking macro. They're worried about growth. They want clearance for the Fed to get a move on. And so, of course, a number that speaks directly to the Fed's mandate is going to be of critical importance. This is what they care about. This is what the markets are paying attention to. And if they get a number that's really weak and gives the Fed clearance, I think the markets will embrace that ultimately. They might get spooked at first, but I think anything that gets the Fed out of bed finally is going to be greeted. But if you get a number relatively in line with forecasts that's middling and softer, but not bad as such, the bleeding and the death by 1,000 cuts continues because the Fed doesn't meet again until September. They would need to start talking very loudly in this direction or that to have any kind of impact at this point, and Jackson Hole is a month away. So at this point, if the number is really, really strong, then the market's growth concerns can get put away, and the market can feel good about saying, you know what, the Fed's waiting, but that's all right. The economy is fine. And if the number is really weak, they can think, oh, good, the cavalry is coming.
I think our Apple earnings may be out, Ilya. Let's just see.
Here we go.
EPS 157 versus 142. A little beat there.
Not bad.
Let's go to the 5-minute chart. Revenue of $94 billion, beating expectations of $88.9 billion. Beat there as well. See the guidance. Lots of individual things here first. Greater China sales, 15.37 billion versus 15.12 billion expected. The net sales overall were 44.58 billion versus 40.22 billion. iPad sales, Mac sales, those all undershot. Wearables, home, and accessory sales also undershot, 7.4 billion versus 7.82. So, I mean, Ilya, maybe there's a story there. People are upgrading their phones before the tariffs came, but then stopped buying everything else. I'm looking for some guidance right now, but share prices are up slightly, 211 here. We closed at 207.57, now in at 211.30. A little bit of a lift for the NASDAQ futures coming out of all of this between our original earnings for Amazon and now Apple trying to find some sort of a low after today's, 400-point move off the high. So tomorrow's non-farm payrolls report. If you're thinking that it's a good news is bad news kind of day then for the stock market, the stock market doesn't want to know it's going sailing for the next 6 weeks until the September 17th Fed meeting without at least someone looking out for them. And by opening the crack a little bit more, are you suggesting that the data's on the softer side? It's not bad yet, but you know what? By the time the Fed gets here, they're going to have to cut. Okay, help's going to be coming. Is that really the best case scenario for stocks?
I think what stocks want here is a tail outcome. They either want something weak enough to wake the Fed or strong enough to convince them that what the Fed is doing is tolerable. And if they don't get a tail outcome, if what they get is a middling outcome, which unfortunately for risk sentiment is also the likeliest outcome, then we end up with something that helps no one, that inspires no one, that keeps everybody's concerns in place at the same time that it tells them, good for you and your concerns, you're going to have to sit on that maybe past September, because the Fed is just not coming to help you unless there is a flashing red warning sign on the economy somewhere. And so at this point, either the market is shown that the Fed is right to be delaying. And by the way, the Fed doesn't think the Fed is right to be delaying. You heard this from Powell. He said, look, there's real emergence of risks to the jobs market that we see, but we just cannot be cavalier with inflation risk from tariffs until we know more. So either something on growth is bad enough that the Fed is spooked and their risk-reward math changes, or they're going to let the economy wait it out on these inflation risks. And so that's really the biggest issue here, is we're going to have to look at a situation where either the Fed is going to get their motivation or the markets are going to get a respite. But both of those things are tail results.
Once we get through non-farm payrolls, and I'm just going to get some different ticker up here on the screen, Ilya. Once we get through non-farm payrolls, what's the most important thing for the market next week?
I think as we look at this next week, obviously there was a absolute flood of data this week for the markets to digest, and they've certainly responded accordingly. We've gotten a lot of volatility. We've gotten a lot of responsiveness. We're going to get a bunch of other sort of not necessarily lesser data points, but sparser data points. We're going to get revisions of S&P PMI data. The ISM services report is coming next week. We haven't even mentioned yet that the manufacturing one is expected to give us the 5th consecutive contraction in manufacturing. That comes out tomorrow. We'll see if that helps. Then we have a Bank of England monetary policy announcement next week. That's interesting for the pound, but maybe not a whole lot else. And then it's pretty much it then, which makes next week actually very interesting. I should, by the way, point out, we also have Eurozone inflation data that's coming out over the next 24 hours that might have some delayed digestion, but again, relevant for the euro, maybe not much else. And then next week, Chinese import-export data also. That's a good input into overall global growth considerations. But in general, it's a little bit sparser next week than it was this week. And I think what that gives the markets, interestingly, is some room to digest all of what they've seen. And we're seeing the price action rebel against the news flow here already, at least as far as corporate earnings are concerned. And we see the markets look at economic data that they've seen and go, you know what, we're going to see the grain of salt in this. We're not going to attempt to justify a positive view. We're going to attempt to justify a negative view. We're going to elevate one kind of a thing within the data because the data is, as ever, open to interpretation depending on what you wish to see. And we're going to emphasize this downside risk. You see it in the growing rate cut expectations. You see it in the unwillingness to rally on earnings, et cetera, et cetera. And so when you look at all of that together, you kind of get a sense for the path of least resistance that's starting to emerge. And without the benefit of big headlines next week, or at least sparser big headlines next week, the markets may be left to their own devices for more of what happens next week. And if this is the path of least resistance that's emerging, then that's not happy news.
How seriously should we be taking the tariff deadline tonight? Because it seems like that's also ignored, not discussed today. I mean, I've been following financial media all day. People have been talking about the tariff deadline as, well, we already have things sorted with Japan, South Korea, Europe, so who cares?
And we've already apparently pushed the can down the road with China, which is another big one. And
Mexico.
And Mexico. And Mexico. I suppose the biggest concern here might be the situation with Canada, but ultimately Canada is not a big enough economy to really sort of spook things to the extent that something like a Japan or certainly the EU, certainly China might have, were that to be a rupture. I think very interestingly, we saw that the president made some really interesting exemptions from his copper tariffs, and copper crashed. And then the president imposed 50% tariffs on Brazil, and those markets rallied. So I think the market is maybe starting to kind of discount all of this to focus on the macro and to basically say, okay, well, yeah, there's a deadline. There's a bunch of countries that are going to get letters. Those letters will probably say that the tariffs are going to be whatever they are. 15% looks like it's emerging as the new baseline. But these are not the kind of huge economies that everybody is going to have a terrible amount of concern about impacting the global macro pie as a whole. And so it is an important deadline and, of course, has tremendous potential to surprise. But it doesn't seem like this is going to be a Liberation Day type shock.
Liberation Day like shock. No, I don't think it's going to be either. Although I'm the guy who said that Apple was going to be down and Amazon would be up here after earnings. So what do I know?
Yeah, but look at Apple on even a 4-hour chart and it hasn't really gone anywhere.
Yeah, what's a 1% move between friends? So I find it very difficult to think that tariffs this time around are going to impact if they get into place. Directionally, when we're going here in April, it's more of the ratcheting up in tariff world. You know, you look at Trump funny, he gives you another tariff kind of situation.
Yeah.
And every day we're one step closer to the edge and he's threatening us more. And then here come the tariffs and it was escalating. There's no off ramp. We're not looking at the market. You know, Wall Street's had the past 20 years. It's now Main Street's turn. We had all those cliche things.
Yep.
And the rhetoric this time is, yeah, the tariff's going to be around 15%. I'm sure we're going to work out a deal. Don't worry about it. It's much softer directionally. So when they do go into place, it's like, yeah, they're going to go into place, but we're still going to talk. I don't know how much juice there is for that because it's still the market's condition that, well, absent materially negative economic impact or deterioration of corporate earnings, then this is something that we probably could just take in stride. So I don't know if we get the tariffs in play tomorrow and then you have a Monday market open with the NASDAQ's -2 because we couldn't solve our trade situation with, you know, Ecuador and, you know, New Guinea, for example.
Right.
Everyone else is a different story. But the encouraging signs for today's market, longer term, the dollar is still very much in the catbird seat here, Ilya. It is extending its gains versus the pound. It's extending its gains versus the euro. The Japanese yen has finally collapsed. Thank God.
No, the BOJ certainly did not help the yen overnight. Governor Ueda came out very, very dovish. Even, by the way, relative to forecast that the BOJ issued, because initially the BOJ made the announcement, they increased their inflation expectations, and the yen actually rallied. And then Governor Ueda came out and said, okay, no. You got to go the other way. Thank you very much. And the yen has since cratered.
Well, Japan's in a really interesting situation because the primary driver of their inflation right now are rice prices.
Yes.
And if you were to say in a normal situation, Japan just import more rice. But they don't want to do that because rice is considered a national staple. It's a point of pride culturally. And they want to have the high prices incentivize more domestic production. So if the BOJ were to hike rates in response to not enough rice supply, would that help incentivize or disincentivize new rice production? It might make access to credit more difficult to come by, thereby making it more difficult to grow more rice. So you have this unfortunate situation now where real Japanese rates are effectively falling out because inflation's going up and the BOJ is saying, yeah, we can't push up nominal rates to match them. So bad for the currency, a currency that obviously still has a very crowded position here, Ilya. The euro, the yen, the pound, all very crowded. How far can the dollar go? Is this a tactical bounce or should traders start thinking about something more? We've gone from the low 96s or mid 96s, I should say, up towards 100 now. Over the course of July. It's a nice, greater than a little bit more than a 4% move. But we have not yet seen a path back to 110. How does the dollar fare in the month of August from your particular perspective?
In my mind, we're in the midst of a dollar recovery that isn't done. I think a lot of what we saw in the first half of the year had to do with sort of structural reasons. Obviously, the Fed has only delayed rate cuts, and the dollar nevertheless had its worst 6 months, perhaps on record. And so when we look at sort of what's behind that, it's not difficult to start to imagine that we had a serious spook vis-a-vis the tariffs. At first, it became a spook about we're going to have less global commerce. And of course, if global commerce is fundamentally transacted in dollars, then less global commerce means less use of dollars. This is not shocking. And so what you end up seeing is first a slow decline, then a faster one, and then a slower one again, while stocks rebounded from April's pain points. The dollar very clearly did not. It just went back to slow decline mode. And that's because the faster decline was about, oh my God, we might see the US purposefully crash its own global financial order. But once it became clear that, in fact, the administration does have some amount of market discipline, does respond when the bond market gets quote unquote yippy, we can go back to a slower decline whereby we're not going to crash the car. We're just going to slow the car a lot. And so we're back by the middle of the year to this idea that we're going to have less global use for its primary commercial currency. That story seems to be all in the market at this point as these tariff plans get cemented, and now we get back to currency brass tacks. The US, with the Fed delay, has the highest yielding currency of the majors, in some places by a fairly significant margin. And so, and with, for example, the Eurozone inflation data this week, we've seen Germany already, we'll see the region as a whole overnight. The sense is that they're not exactly rate hikers next year, despite the fact that they're probably almost done cutting. So we're probably getting back to a dollar that has significant room to recover now because it has yield advantage, and the risks to its sort of structural underpinnings seem to be fading. I think there's more to go here. I'm probably very long now. I've gotten short the Canadian dollar now. I've upped the bet on the Australian dollar, and at this point, that's in my mind the path of least resistance until further notice.
Ilya, it was just you and me today for overtime. We were fortunate that we were able to get Yumi and Radigan together yesterday on the show. So we're going to wind this up a little bit early so you can catch your breath and get ready for your next Macro Money segment. Non-farm payrolls are tomorrow morning, 8:30 a.m. Eastern, 7:30 Central Time. ISM manufacturing will be 10 a.m. Eastern, 9 a.m. Central Time. We've gotten through what's been a very busy 2 days so far. It's acronym week, earnings week here. GDP, FOMC, now NFPs due up. Ilya, you're going to be back in a few minutes' time. Get some water, folks. Get a quick rest. We'll see everyone on the other side of a quick break. You're watching Tasty Live.
Everybody, and welcome back to Risk and Reward of the Week. Today's Thursday, close to the end of the week. It's been pretty volatile. We're going to get into some hot topics of today to get your guys' thoughts on it. But how are we doing so far into the week, Gus?
Yeah,
some hot topics.
Doing well. Yeah, hot topics for sure. We were just having a highly inappropriate conversation that Errol took right up to the to the buzzer here. But yeah, no, doing good. It's been a horrendous week for me in the market, I must say. You kind of hit the nail right on the head talking about with your risk of the week with SPY, with 5 straight green weeks. We were due for a little bit of a week of breathing. We just closed our 3rd straight red day today, and that comes after Meta and Microsoft both blew earnings out of the water this morning. Yeah, not even that was enough to prop up the S&P for the day. So yeah, it's we finally got a little bit of chop, and it's not even really like a breathing period or like this considerable downturn. It's just like we finally aren't going up every single day anymore.
We had a really large move after the bell yesterday. We gave a lot of that move back today. I mean, it always feels like the sell-offs feel a lot more aggressive and a lot more intense than the moves to the upside do. So excited to get into that today. As for the market, I mean, I do have a few positions on. I was short on one of the earnings for Meta yesterday, and I mean, they blew it absolutely out of the water. So we still got the UAL position on. That one was from earnings, and I'm still sitting break even on that. So we'll get into all the details there. But it is Thursday. We do have some topics to talk about. And you heard about any of the Sydney Sweeney topic buzz drama going on right now?
Yes, who hasn't heard about the Sydney Sweeney? All this buzz going on right now. It's this really interesting amalgamous thing that has some people very upset, has other people celebrating for a whole variety of reasons. And yeah, we're gonna dive in and talk some Sydney Sweeney. If you guys aren't familiar, I'm a big Sydney Sweeney fan myself for her acting ability.
Of course,
I just think that she's a wonderful actress.
Absolutely.
That's it. There's no other reason. No ulterior motives here.
Absolutely.
I think she does great work in commercials. I think the Dr. Squatch commercial where they put her bathwater in the soaps, I think that was funny.
You know,
it's a good marketing campaign.
It was good It sounds so outrageous, but I think that's what marketing is at the same time. Good marketing that pierces through the noise, but at the same time, the bathwater. Can you give us a little bit, real quick, as we get into it? And I think it's funny because I think it's culturally relevant. Give us a little insight on what was that bathwater in the marketing for Sydney Sweeney, those kind of things.
Sure. Let's go even broader. Okay. Sydney Sweeney, if you're not familiar with her, she is a very successful actress right now. Perhaps, probably a top 10 most successful actress that's out in the world right now. She came up, she's been acting since she was young. She came up on Disney Channel and then jumped over to, did we decide it was Riverdale? No, it's Euphoria.
It was Euphoria.
Got her first big adult role on Euphoria.
That's when I initially found out.
Yes, and that is when she initially shot into relevance was through her role on Euphoria. She's done a number of movies since. She just, I know she had a big rom-com that did really well last year. And she is very attractive. So lots of companies have I guess, gotten her for marketing campaigns to lean into the fact that she is very attractive. And one of them was Dr. Squatch, which is a soap company. They make soaps that they say are natural. I actually used Dr. Squatch soap for a little while I was in high school, but it really dried me out. So that's my personal take. But I got eczema and stuff, so I kind of need, I got a dermatologist recommended soap now. But she did a marketing campaign for Dr. Squatch soap where they were taking her bath water and putting it into bars of soap. And that was the entire marketing campaign. Low-hanging fruit for sure, but also, as Errol alluded to, in this day and age with marketing and with everybody having the ability to market on social media freely and however they see fit, you kind of do have to do something to be able to cut through all that noise and get people buzzing about you. And companies seem to be finding that Sydney Sweeney is a good way to do that.
100%. And I think with the bathwater, I wanted to bring it up, the fact that it was culturally relevant. And don't worry, guys, we're gonna tie this into what does this have to do with the market. We'll talk a little bit about
this has strong market ties, people.
Stock.
Just bear with us.
But I do think it's really culturally relevant just because, what's funny? The bathwater is so outrageous just to even think about. They know that. That's why these headlines are going to be buzzing. The bathwater came from TikTok comments. If nobody else knows that, right? If you're a Gen Z and you're reading up in those comments, that was a joke initially.
Oh, yeah. Like, let me drink your bathwater.
Right, absolutely.
I would do X, Y, Z just to be able to.
Right. Exactly. So this is where it came from, just to add a little bit of context. Because if you think about it.
Simping is a new phenomenon as well. Yes, correct.
So with the whole bathwater thing, it might sound like it came out of nowhere, but it was actually really culturally relevant, especially if you're a younger individual on TikTok looking at the comments section. So.
Yes. And I do think, credit where it's due, I think Belle Delphine invented the bathwater thing. I think she was the first one.
Was it?
I think she was the first one that was ever out here selling bathwater. So shout out to her. But again, I think that was created from the prominence of that sort of commentary. Yes. So selling bathwater. Guys, don't buy bathwater. Don't buy bathwater. Don't buy cans of farts. Don't do any of these things. Don't, please.
And if you do, just take it to the grave.
If you're ever thinking about it, think about me and don't do it for me. I'm asking you personally. But let's dive right in here. Sydney Sweeney has great genes. Sydney Sweeney made headlines this week following a raunchy ad campaign with American Eagle, but is the outrage justified? And more importantly, What impact did this have on the market? That's a big one, a way bigger one than you would think from an ad campaign. So let's dive right in here. So first and foremost, the ad itself. Sydney Sweeney is running an ad campaign with American Eagle right now, and the tagline for this entire campaign is Sydney Sweeney has great jeans. And they spell jeans with a J. American Eagle sells jeans. That's
off the bat. When I saw that, I was like, oh, that's fire marketing.
It's a bar. Immediately.
That's a bar, and that was my initial reaction.
Yes.
Before reading any comments, anything like that, I was like, wow. Give that intern a raise.
Yes, exactly. Whoever came up with this, I absolutely agree. American Eagle, obviously jeans are one of their primary products. Sydney Sweeney, an incredibly attractive woman, obviously has good genes with a G. This is a fun little tie-in that came about. But they took a raunchy angle. They leaned into her sex appeal, which is something that she has, expressed that she's comfortable with. And more power to her, by the way. I will say, I said to Errol earlier off air, if I were Sydney Sweeney, I would be doing the exact same thing. I can't imagine how much money they paid her for this. Yeah, exactly. So here's a few screenshots from the ad campaign itself. There is many, many more. I was able to source like 8 or 9 different cuts that they did of this ad earlier this morning. But these 3 screenshots along the top are from what's going to be our specific advertisement.
So it was like frame by frame.
Yeah. That's going to be our specific advertisement of interest for the day. This is the one that has created a lot of outrage, and it has not, and this is important to emphasize, it has not created much outrage because she is leaning into her sex appeal.
Right.
People rather are upset about the jeans comment,
right,
which is the bigger issue. So kick us over here. Tell us about the backlash, Errol.
We got a little bit of backlash. If you were on Twitter today at some point, as we've seen in the comment section right here, you did see Tom in a very similar outfit. Don't be alarmed. But as we get into a couple of these tweets, this is where a lot of the criticisms really came from. Over here we have it comparing it to, the sex workers a little bit. Sex workers equals heroes and Sydney Sweeney. So hard to see the comments on that one. But you can see a lot of the backlash from Sydney Sweeney sexualizing herself. And you made a comment that I want to piggyback a little bit off of earlier today, was the fact that, times have changed. It is 2025. I think we have to take into account what the younger generation is a little bit more comfortable, what's a little bit more socially acceptable. On that topic, I think it is a little bit more supported. So I think it is a little bit hypocritical to push back on the sexualized angle that people are taking the criticism from on Sydney Sweeney, because at the same time, the younger generation, or at least our culture, we support that a little bit more. So it does kind of seem like a cultural hypocrisy at the same time. So that was my initial take from some of these screenshots and criticisms that we see.
Yeah, that's absolutely something. And it's like, it's this initial reply from this Volo individual on Twitter here. Does Sydney Sweeney do anything besides sexualize herself? And it's like, yeah, if you want to take the stance of women should not sexualize themselves for profit, I can absolutely respect that, but you better hold that stance across the board.
Absolutely.
Like what I was saying to you earlier today is you can't say this about Sydney Sweeney, and then when one of your girlfriends says that they want to start an OnlyFans, say, oh, yes, queen, do that. Get your bag. You have to pick one lane or the other. And as long as you're consistent in it, I can respect whatever your viewpoint is. But yes, this Jack Mack individual then draws great attention to the point that is sort of a hypocritical stance to take, especially in the modern age. So yeah, that's the sex appeal side of it. Let's dive over into the, I don't know. I don't want to use the word woke.
More backlash.
Yes, but the heavier backlash side of it. Yeah. Many people were very, very upset about the jeans part of this and insinuated that because Sydney Sweeney is a white woman with blonde hair and blue eyes, that this somehow was Nazi symbolism or has Nazi undertones. Now, I don't get political on this show ever, and I don't think this is a political comment that I'm about to make. I think that is ridiculous. And specifically, the specific quote is, she said, I have great genes and my genes are blue.
Right.
And then people are taking that and interpreting it as she's talking about her eye color, eugenics is mentioned, dog whistles, all these buzzwords that people like to use these days. But it's just not that. Like, this just feels like as we said at the beginning, it just feels like a good campaign to me.
I've been offended at things before. And typically, if I'm ever offended at something, if I'm honest with myself, at its core, it's rooted in insecurity, right? So I think that whenever we see takes like that online, it could be, if we crank the data, it could be rooted in a little bit of insecurity. And that could just be like the initial reaction. Completely agree.
Yes. Right. And I would be inclined to agree with that viewpoint, especially as it pertains to her sexualizing.
Right, absolutely. Yeah.
Yes.
Yeah,
because
100%.
she is obviously incredibly attractive and perhaps insecurity plays into that. And I think that it could absolutely be true here as well. I'm seeing engineered outrage in the chat. I think that's
it's like human behavior.
Vernacular.
How do humans react to certain things? Another attractive woman, it could cause a little bit, depending on how we market her. Also, with the bath soap, I think she also realized, or their marketing team, her whole team probably recognized her name was catching so much buzz. The bath soap was the first thing, right? And American Eagle and some other ads came after that. So I think they noticed that, wow, this towing the line with our marketing is working really well. And we ended up seeing a breakout with that American Eagle ad.
Absolutely, yes. As we're about to get into here in a second. And,
right.
And I mean, no big deal. And the point is, though, that we are sitting here talking about this right now. I mean, that means that this is a good advertisement. It gets people talking. It creates brand awareness. I don't know when the last time I even thought about American Eagle was. And actually, I know.
True.
I can tell you the last time I thought about American Eagle, and it's when they signed Addison Rae in like 2021. So American Eagle doing good things, with their marketing. But anyway, let's we can dive over here and let's talk about the impacts of this.
We got a little bit of impacts on the American Eagle. Shares surged 23.3% from $9.65 to $12.20 after the new ad campaign that sparked a lot of outrage. Shares have since settled around $11. It's a pretty cheap underlying, not too expensive, but it still reflects about a 14% gain driven purely by this campaign that we've been seeing. No reported sales boost or change in fundamentals. So purely, we don't always know exactly what moves a stock. We don't exactly know why people are buying and selling, but with no fundamental changes or no new news for American Eagle besides their campaigns, I think we can credit this recent volatility towards what's been going on with Sydney Sweeney.
Yes, absolutely. And it's insane that this kind of move can even happen. Even if American Eagle gives all of these gains back and they wind up just settling back in at their share price, which logically they should do. Nothing has changed about the fundamentals of the company surrounding this until we see more sales numbers or something like that. But the fact that a single ad campaign can have this type of impact, can swing you up almost 25% in the stock market, is insanity. And it's purely because of the ad.
Yeah.
So yeah, moving forward, is this brilliant? Starts to become the question. American Eagle shares are currently sitting up 14%. Searches here, that's this top blue line Google Trends bar here. Searches are up 500% for American Eagle in the last, in the last month, I should say, rolling month. This collab, it trended for 2 days on Twitter, X, it was everywhere. And yeah, ultimately the controversy has just boosted the brand of both people. There's a ton of buzz everywhere, including right now as we're sitting here for Sydney Sweeney, for American Eagle. Search results are way through the roof. Obviously, brand awareness has increased and you tangibly increased your market cap. I mean, what more can you ask for out of an advertisement? That's more than you usually can ask for out of an advertisement.
100%. I mean, it kind of sounds like we're going back to some of the marketing that is really towing the line. I think that gets a lot of engagement, that gets a lot of traction. I think really what it comes down to at the end of the day, to just based off of pure personal speculation, is I think marketing teams are getting with the times. I think that's really what it comes down to. I think marketing teams are learning social media a little bit better. I think most marketing teams are recognizing that to be competitive, you have to be on social media in some capacity. So I think we're kind of seeing a change in just the marketing culture, because I think it's like the Titanic. It's like a big moving ship. It's like it goes from the TV running ads. Now it's like these companies don't even have budgets to give companies that are looking to be on TV anymore. Now it's switching to social media. And now a lot of these people are getting the budgets for that. So I think what it really comes down to is just a shift in a lot of the marketing culture.
Absolutely. And I think there's also a major factor of, knowing your clientele. And obviously you would never want to do any advertising that alienates your clientele. That goes without saying. But beyond that, yeah, American Eagle recognizes that their clientele, the people that they're trying to appeal to, are culturally aware of Sydney Sweeney, are primarily on social media. And I think that Sydney Sweeney's management team is starting to realize that they kind of have a modern day Marilyn Monroe sitting here, and they're taking their opportunities to leverage that. I don't think it's a shortcoming on the part.
Or do you think, I just thought about this, you think they missed their target audience and it blew up even more?
Perhaps.
Or maybe their target audience helped prop up the attention and then it garnered more attention. I don't know, but it's something to think about.
I mean, fundamentally, I think that modeling with clothing companies, and regardless of gender, both ways, has always been about showing attractive people wearing your clothes and trying to insinuate to us, the viewer of the ad, that, oh, you can look like this too if you wear our clothes. And so I think that they haven't really changed the model all that much. They just decided to be way more direct about it.
Right.
And I think that that's an interesting angle to take. Yeah. But yeah, that's what we got on the slides for Sydney Sweeney.
Oh yeah, we'll check it out. American Eagle's a lot cheaper underlying than I would have expected. It's not something I was personally trading. But
yeah, American Eagle and Abercrombie, those are the middle school, high school staples.
Yo, wait, Abercrombie, I feel has gotten a lot more popular in like the last 3 years.
You think?
I think so. Unless I just wasn't with the time. Like, I don't recognize I haven't been with the times in certain regards until I hang out with my brother. To be honest. Like, Joe, you know,
Sure.
you know T.
Sure.
Yeah. But no, I digress.
Yeah. Well, yeah. It's like having Thomas out there. Like Thomas,
Right.
he makes me.
It's
feel
like
old.
little
I know you're
things.
watching, Thomas.
Right,
We
yeah,
love you.
yeah.
But yeah, these little like nuanced things. It's
But
like
it used to be like that was me. That was me. I don't know how I missed that. That was me.
It's funny. I guess we're just having a conversation about aging in general here now, but it's funny because I always kind of had this idea, like in high school and in college, you know, when I would say I was still with the times or whatever, and I think I still very much am. To
All right, old man, calm down.
Yeah, exactly. This guy's born in the 1900s trying to talk shit to me. But I think that I always had this idea that, oh, well, you know, all these ideas are exchanged on social media, and I have no, you know, ideas about leaving social media anytime soon, so I will probably stay with the times. But what I did not account for is that my interests and the people that I follow and what the algorithm feeds me on social media will change, and suddenly these, you know, the things that are being created from shit posts just don't appear anymore.
So there's one of my favorite quotes is the fact that the stock market is a direct reflection of yourself, and I feel like we could say your algorithm is a direct. I don't know, maybe that's a reach. Your algorithm is a direct reflection.
I mean, it is
a little bit.
It's supposed to be.
It's supposed to be, at least. We do just have a few more minutes left here. Anything else to add on the comments with Sydney Sweeney, American Eagle? Anything else you got on your mind heading into the end of the week, Gus?
I think that there's a lot of people who wake up every day and go out into the world and look for things to be offended about. And
True.
I think that is a sad way to live life. And I think, and if you are one of these people who is offended about this, I beg of you, go outside.
Yes.
Please go outside, experience the world. People are actually pretty chill across the board.
So one thing that I have noticed is in my 50 years of life is typically when others
you're like 10% older than me. Give me some sage advice, man.
Well, I've noticed typically when others are acting or have actions that kind of spill onto you a little bit, or someone is maybe lacking some self-awareness here, and here, typically they're going through something on their own. Like typically, whatever it might be, and then it's just spilling onto you. And I think a lot of the times then we'll latch on to a lot of these things that help us feel in the current state that we feel. Oh, negativity. I feel that, so I can latch on here. I can chew you out. I can do this because I'm in that state. So a lot of the times I've also recognized that. So I think it's just a check. Like if you recognize you're scrolling on social media and you're getting offended and like it's working you up, just take a quick moment and pause and be like, yo, this isn't a way to live life, first of all. And then second of all, it's a key to look inward. So I'm gonna leave it with that.
Yeah, absolutely.
Because I find myself getting riled up sometimes about stuff I see.
Absolutely.
Online. I'll be
absolutely.
Like, oh,
yeah, and that's absolutely something that's come with maturity as well. I mean, when I was like 15, 16, 17, I was fighting with people in Instagram comment sections on the daily about whatever. You say something I agree with.
And you can articulate yourself really well too. So you were probably giving them a field day.
I'd give you the business. I'd break out like the specific fallacy that you're committing and all this. And at a point, I just realized that all these, it's not real. Why would I waste my time and stress myself out and get myself worked up about these things that are online? In reality, if you actually go out into the world and walk around, it ain't that bad. Everyone's very nice to each other at large. And I would further add that, there's an old adage that I still think is absolutely true in a person-to-person context that you're the average of the 5 people around you. But what I think that people haven't accounted for as we've moved into this age of social media is that those 5 people around you might not actually be people in your life, or that all of your social media following or whoever's validating you in these comment sections or fighting back at you, that can also, those play in.
You find community outside of real world. Absolutely.
Yes, absolutely. So I think that it's just important to always consider who you're surrounding yourself with, and that extends beyond just who you actually physically see or talk to on a day-to-day basis.
I see here. I'm gonna have to do more research on the Sydney Sweeney woman. Our segment worked for today.
Grey Poupon mustard? I know about Grey Poupon. There's a commercial. Oh man, Dad, if you're watching, I'm so sorry. He would quote this commercial all the time. It's like, do you have any Grey Poupon? I think that's what it is. Can somebody fact check me on that? I think that's how they advertised. But yeah, that's a big thing.
I'm not a big fan of mustard. I just can't.
I was made to.
That's one thing I've never got around to.
I never really. I don't know. Mustard. It's actually just like last year. I've kind of started liking mustard a little bit. Yeah.
Dang.
When I was in Yellowstone National Park last weekend, for the first time in my life, put mustard on something.
Wow.
I got a burger.
And you enjoyed it?
Yeah. I enjoyed it. Got a burger. I was like, oh, this is it's missing a little something. That mustard was staring at me like a goblin mask.
I don't believe it. Well, that's going to wrap it up for today's segment. Tomorrow's Friday. Anything else to add before we hop on out of here, guys?
No, nothing. Cool. This was a great discussion.
That's going to wrap it up, guys. Thanks for taking the time to hang out with us. Be sure to stay tuned for more segments coming on next. We'll catch you guys next time. Peace.
Amazon earnings are out. Apple's up next. It is Thursday, July 31st, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivaks in San Francisco. No Radigan today. He'll be back with us on Monday. But we're here for now to take you through the futures market close at 5 Eastern, 4 Central. If you're on the platform Tasty Live, nope, that's the website, tastylive.com. The website's Tasty Trade. Either way, welcome to the show. Come over to YouTube. Tell us what you're trading, what you think of this action. As Sunagoon said, was my bouncy, boyish joyousness yesterday the sign of the top? Maybe indeed. The NASDAQ did rally up here today, only for a little while before it came crashing back in. We have a Microsoft and Meta earnings jubilation overnight, adding more market cap than, say, the entirety of a Costco or Netflix, as we see, is eradicated, and then some today, where we do ultimately get a move and close below yesterday's low. Ooh, so spooky. An engulfing bar. Key reversal at the end of July, heading into the seasonally most bullish time of the year for volatility. Ilya, Microsoft and Meta did make a ton of money, but the market today decides to take some profits. We see a NASDAQ surge to new all-time highs and close below yesterday's low, which is among the worst things that could happen. If you are a bull and have been riding this Icarus into the sun, the wings have, technically speaking, perhaps melted off at this point in time. But we do have Amazon out here after hours. And before, Ilya, we go into this price action for today, I do want to go to the chart. Those earnings are better than expected across the board, which is what makes this reaction, Ilya, as you pointed out, all the more interesting. They beat on EPS, $1.68 versus $1.33 expected. That's a 33% beat. Their revenue is $167.7 billion versus $162 billion expected. Another fantastic beat. The guidance for Q3, the high end was $173 billion. They've guided for $174 to $179 billion. And AWS, which contains their AI efforts, $30.9 billion, 17.5% growth. Ilya, even Amazon here with its strong earnings in the mirror and reasonable growth expectations moving forward, the market is not running with this either, despite bidding it higher all day. We await Apple in a few moments' time, not just yet. But as a bear's bear, as someone tweeted at me today, you were probably feeling really good.
As we were talking about those spikes on the Meta earnings and the Microsoft earnings exactly 24 hours ago now on yesterday's show, my concern with that exuberance was that what happened earlier in the day was the market's displeasure with the Fed, and the exuberance was coming on the back of catalysts that were perhaps short-lived. Those earnings were undeniably impressive, and we didn't learn in them anything that the markets hadn't known. What we learned was perhaps that the forecasts were woefully inadequate, but that was just about it. And what I was concerned about was that the story with the Fed was a bigger story, and that we had to be careful before we over-extrapolated a move in absent liquidity before the Asia Open even got underway. And indeed, things held up. They held up in Asia, they held up in Europe for the most part. And then when the US market came in, the price action told you very clearly what they thought. And the whole thing caved in on itself. So this was exactly the thing that I wouldn't say I knew that it was going to happen. Of course I didn't. Nobody could. I was concerned that it might. Because the price action around the Fed and the remaining event risk for the week really did look potent. And of course, the event risk is relevant. So what the markets are telling us here, seemingly, is that good news is unable to impress. And that is more bearish than if the markets were falling on bad news. And that should be a point of concern for risk sentiment all around.
Amazon here, 228 now, right after hours. That action today in the NASDAQ, very brutal. You were asking me how hopefully I got out of my stuff. Partially, over the course of the day, as I was talking with Nick, it's funny, I sent Nick a message this morning at 10:12 a.m. Eastern time, and I said, this thing is either going to close at all-time highs or we're going to close red today. And that seemed nuts at the time. But the read I was getting on the tape was that you were seeing the Russell fail in certain areas. We can go over to that 15-minute chart just to show.
That thing has been heavy as a rock, obviously, despite the tech earnings where it really couldn't benefit.
10:15 this morning is basically 2240 in the Russell. Why there? Why at that point in time? I would go down to the daily chart, the 4-hour time frame here. And this morning we had broken out of a flag and we were trying to get back into it. So if the Russell of all things could get back into its flag, then surely the NASDAQ and the S&P would be okay. That obviously wasn't the case. So we have a turn lower here, which now potentially we do need to consider, as Tom was suggesting, are the bears in control now? Is this a potential marking for a top? We do have tariffs going into play tomorrow, Ilya.
Maybe, yeah.
Do have non-farm payrolls potentially coming out tomorrow morning. Well, they're definitely coming out tomorrow morning, but that is potentially something that could be a catalyst in this market as well. We're still digesting the Fed. Are we for the stock market at least, are we still in a good news is good news world, or is good news bad news now because the Fed won't have an excuse to cut rates? I'm trying to figure out what the thematic narrative is on that lens after this week. I think we're going to have to think about it for a few more days once we see an FP.
Yeah. I mean, in my mind, it's kind of neither. It's middling data is the worst for risk sentiment. Because I think the markets very clearly are telling you that they want these rate cuts. There's just no question. The markets are also seeing that those rate cuts aren't going to happen near term. I mean, just look at what the pricing is for Fed funds futures for next year. We're out to 83 basis points. The markets see at least 3 cuts, and they're inching closer to 4. What we see from the Fed, obviously, is only a single rate cut that they've forecasted in June. Obviously, take that with a grain of salt. They're probably half-hearted on the 50 basis points that they projected then for this year, if you hear them yesterday. And the market's obviously now hearing that loud and clear. You can see it in the dollar, certainly, where the markets only have 1 cut maybe for the remainder of this year. We're out to 29 basis points. That's making now September look unlikely by about a 40-60 spread. 60% chance rates actually don't come down in September.
That was perhaps one of the shocking developments of today's market. Post PCE, we have a market that's saying the odds of a September cut are less likely.
That's right. Well, and with that, the worst thing that seems to stand here in the way of markets is jobs data that's weak enough to keep their desire for rate cuts alive, but strong enough to give the Fed cover to delay. And that's probably the worst of all possible outcomes, and also the likeliest of outcomes. Because if you look at the expectations, we're looking for 110K. That's down from 147. It's slower, but it's not catastrophic. It's not anything that's going to get the Fed to go, oh my God, emergency meeting, or oh my God, we need to sound so dovish from here that there is no question about September. And maybe we'll even go big. You would need a catastrophically weak number. You would need something in the double digits, maybe, with a potent rise in the jobless rate. It's already expected to go up, so that bar is high. It's expected to go up from 4.1 to 4.2. If we spike to 4.3, okay, maybe you might start to stir some hope in the markets. But now, clearly, the market is saying there's a slowdown coming because of the exchange rate in rate cuts from this year going away to rate cuts next year going up by a greater amount. And the markets are very clearly saying here, look, we're not going to be impressed with AI capex. We're not going to be impressed with Amazon earnings. We see a growth risk and we want these cuts. So if you get a number that lets the Fed off the hook on that, sort of in line with expectations, but doesn't tell you, listen, maybe you don't need rate cuts because the economy is fine, that's the worst of all possible worlds.
We're still waiting on these Apple earnings. As soon as they come out, I will relay them over here and we'll go over those Apple charts themselves. Ilya, even though the NASDAQ itself had the benefit of those Meta and Microsoft earnings, you would argue that perhaps it would be a little bit weaker here today otherwise. Even so, the Russell is the biggest loser to the downside, and we're starting to get into a place where if support were to be found, this would be a pretty darn good place to find it. In this current environment, if people want to be bullish, how are they structuring their trades? Are they doing this on like a day-to-day basis and kind of just dipping their toes in the water to see what they're doing from pull to pull, 9 a.m. to 4 p.m.? If you're bearish, do you give yourself a little bit more breathing room? How would you approach this? Because I'm thinking about whether or not how my approach has been for the past few weeks is still viable, which is to say that basically buy NASDAQ calls that are at the money, slightly out of the money, call spreads, and then look long S&P 500 puts at the 45-60 DTE window, if only to hedge off some of that risk. Today's action does kind of scare me. It kind of is like the worst possible thing that could happen after Microsoft and Meta earnings.
Yeah. I mean, I think at this point, you have to listen to the price action first and foremost. And what the price action is telling you today is that the market is shrugging off what a month ago would be unmitigated good news. And when you start this from the premise that you began this week with an upside gap after the world's most important growth engines, at least two of them, the US and the EU, finally reached a trade deal and took that uncertainty off the board. This is most of the world's end demand. If China is the middle step and the third engine in this sequence that really hold up global growth, China is the middle of the global supply chain. Europe and the US are end demand. That's the consumption that keeps everything going. And you got a trade deal there. That is an immensely positive development for global growth. And we're down on the week across every major stock index. So that was a tell early. The Meta and the Microsoft earnings being a flop, despite having lifted those stocks. I mean, Meta is up almost 12%. It's not like the market doesn't think the data was good. It's not like the market perceived some sort of a tarnish in the results. No, they were a complete positive as far as the markets were concerned. And that could not hold up overall sentiment. I think at this point, the market is telling you very clearly that there is a tendency here emerging towards some kind of distribution. And so while you don't want to run in front of a market that fundamentally doesn't like going down, the US equity market is generally that way. And I would argue equity markets are that way in general. They're biased. When they do go, they go because it becomes a fire sale. And so looking at the situation now, I think you look at the Russell, you're directly at support at about 2210 or so. It's probably not attractive to be a seller right here, but you get a breach of this support and you might have an avalanche underneath it. It's a similar story with the S&P, where if you're looking at the September contract, then 63.30, 63.45, something like this, former range resistance turned support, is now very much under fire. You get through that, again, danger. If you look at the NASDAQ, you have what is a very scary looking engulfing candle on the daily chart at this point. And you have very little defense. You have something maybe around 23,000, something else maybe around 22,800, something like this. But at this point, you're very much looking like a top is a live risk. And again, you're near, in the near term, former resistance turned support. So it's probably not the greatest risk reward to lay out aggressive shorts. But if ever there was a time to look at vol sub 20 across all of these things and say, all of them, the NASDAQ is probably the one with the most bearish signaling and the best risk reward relative to immediate support levels. If I'm looking to sort of consider the possibility that maybe sentiment has finally peaked, you can buy put verticals very cheap here. And you could introduce duration into those put verticals that helps to buffer you from near-term volatility and still gives you excellent risk reward if something asymmetric occurs. And ultimately, if you have to let it expire worthless because the stock market doesn't care and powers higher, and you take a loss of 1 to 2% of equity, so be it.
The key development for me is the fact that the NASDAQ lost 23,440 or so. We had the pivot highs here over the past week. We break out, we hold that support. We got the big rally up there. Just for what it's worth, this range, 23,100, 23,440, that's 330 points, 330 on top of 440 gives you what, 770?
Mm-hmm.
So last night we hit a high of 23,845. The measured move technically completed overnight before we pull back in. Now that we lose 23,440 again, support comes in back at the former swing highs in the short-term basis. You have that low intraday on July 22nd at 23,108. I called it 23,10.
Yeah.
Okay, so we have something.
That's about where I've got it.
We have structurally. That's to work with here for the S&P. It's a similar setup. It probably means you got another 30 or 40 points to the downside, 0.5% or so, before you start to find some support. But the big picture, Ilya, is right now, as we reconstituted a few days ago, if this is indeed the trend that we've been in for the past several months, going back to just around the time that the US and China agreed to a truce in Geneva in May, we've been bumping into the top side of this channel for some time. And this uptrend that we've been in since May, a 3% pullback from here gets you close to 6,200. And then at that point, you'd have been more than 3% off the highs. And you can make the assumption, okay, we now had a 3 to 5% pullback. Is this something I'm interested in buying the dip on? And when you get there, maybe it's mid to late August and you have yourself looking at September. And if you start to break down from there, then you have your September spook, as one usually does. But taking this methodical right now, I think, is the most important thing. Look at how much money some of these tech companies are making. I think the growth scare, though, is the big point. Now, I don't know if it's materializing. I want to just be clear about that, because if you're looking at the data are still very muddled. You can't ignore the fact that third quarter GDP tracking began today, Ilya. And the Atlanta Fed, which, to give them their accolades, their flowers, they had a 2.9% expectation for 2Q.
The Atlanta Fed really nailed it here.
Yeah, the Atlanta Fed was really nailing it. 2.3% is now their third quarter. So they're not saying that like, okay, second quarter was just an adjustment. Maybe there's still adjustments happening because of government spending and exports, imports, tariffs, but they see underlying growth at least holding up for now still.
Mm-hmm.
I guess that begs the question. I want to go over to Apple real quick here because I see that we're talking through things. Apple, is this up a little bit? Looks like it's up a touch, actually. That might be nice. Directionally wrong on both, Chris. Good assessment. Apple earnings. Let's see. Maybe not. No, I guess I haven't seen anything.
No.
Just the market getting a little jumpy. Okay, 4 more minutes. Non-farm payrolls tomorrow.
Yes.
Tramal and I were speaking. He thinks that this is going to be a decent enough report. It's not going to bother the market. Tom was a little surprised when he saw that the implied move on ES through the end of the day tomorrow is basically 50 points in either direction.
Mm-hmm.
That's not necessarily what we've seen going into recent non-farm payroll reports. It's been 27 to 30. Why do you think the market is giving extra weight to tomorrow's report?
Well, let's do just a little bit of sequencing. What have we seen all week? Fed rate cut odds have diminished, and the Fed endorsed that idea for this year. They have likewise grown for next year because the markets want the cuts. They think the cuts are necessary, and they don't appreciate this delay. That they don't appreciate the delay tells you they see some reason that there is concern about growth. And frankly, the second quarter GDP data doesn't do much to dispel that idea, despite the headline number of 3%. Because once you strip out all of those distortions for imports going from surging to nothing, inventories starting to come down and pull down investment numbers, because we're finally starting to spend out of those inventories that were front-loaded in the first quarter. By the way, we're not refilling them at the higher prices. That tells you what wholesalers think about demand. But most importantly, we saw the weakest 6 months of household consumption this year since the first 6 months of 2020, the COVID recession. And that's 68% of the economy. So the markets were validated in thinking, you know what, I think, or we think there's a growth risk here that's mounting. Because that's the part that matters when you take all of the noise out of the equation. So the markets want these cuts. We have since gotten a spate of relatively good corporate news, and the markets plainly don't care, but for episodic jumps, as we just saw, and as we just talked about, Meta, Microsoft, even Amazon. That one couldn't even manage an episodic jump. So when we look at all of this together, we end up with the idea that the markets are thinking macro. They're worried about growth. They want clearance for the Fed to get a move on. And so, of course, a number that speaks directly to the Fed's mandate is going to be of critical importance. This is what they care about. This is what the markets are paying attention to. And if they get a number that's really weak and gives the Fed clearance, I think the markets will embrace that ultimately. They might get spooked at first, but I think anything that gets the Fed out of bed finally is going to be greeted. But if you get a number relatively in line with forecasts that's middling and softer, but not bad as such, the bleeding and the death by 1,000 cuts continues because the Fed doesn't meet again until September. They would need to start talking very loudly in this direction or that to have any kind of impact at this point, and Jackson Hole is a month away. So at this point, if the number is really, really strong, then the market's growth concerns can get put away, and the market can feel good about saying, you know what, the Fed's waiting, but that's all right. The economy is fine. And if the number is really weak, they can think, oh, good, the cavalry is coming.
I think our Apple earnings may be out, Ilya. Let's just see.
Here we go.
EPS 157 versus 142. A little beat there.
Not bad.
Let's go to the 5-minute chart. Revenue of 94 billion, beating expectations of 88.9 billion. Beat there as well. See the guidance. Lots of individual things here first. Greater China sales, 15.37 billion versus 15.12 billion expected. The net sales overall were 44.58 billion versus 40.22 billion. iPad sales, Mac sales, those all undershot. Wearables, home, and accessory sales also undershot, 7.4 billion versus 7.82. So, I mean, Ilya, maybe there's a story there. People are upgrading their phones before the tariffs came, but then stopped buying everything else. I'm looking for some guidance right now, but share prices are up slightly, 211 here. We closed at 207.57, now in at 211.30. A little bit of a lift for the NASDAQ futures coming out of all of this between our original earnings for Amazon and now Apple trying to find some sort of a low after today's, 400-point move off the high. So tomorrow's non-farm payrolls report. If you're thinking that it's a good news is bad news kind of day then for the stock market. The stock market doesn't want to know it's going sailing for the next 6 weeks until the September 17th Fed meeting without at least someone looking out for them. And by opening the crack a little bit more, are you suggesting that the data's on the softer side? It's not bad yet, but you know what? By the time the Fed gets here, they're going to have to cut. Okay, help's going to be coming. Is that really the best case scenario for stocks?
I think what stocks want here is a tail outcome. They either want something weak enough to wake the Fed or strong enough to convince them that what the Fed is doing is tolerable. And if they don't get a tail outcome, if what they get is a middling outcome, which unfortunately for risk sentiment is also the likeliest outcome, then we end up with something that helps no one, that inspires no one, that keeps everybody's concerns in place at the same time that it tells them, good for you and your concerns, you're going to have to sit on that maybe past September, because the Fed is just not coming to help you unless there is a flashing red warning sign on the economy somewhere. And so at this point, either the market is shown that the Fed is right to be delaying. And by the way, the Fed doesn't think the Fed is right to be delaying. You heard this from Powell. He said, look, there's real emergence of risks to the jobs market that we see, but we just cannot be cavalier with inflation risk from tariffs until we know more. So either something on growth is bad enough that the Fed is spooked and their risk-reward math changes, or they're going to let the economy wait it out on these inflation risks. And so that's really the biggest issue here, is we're going to have to look at a situation where either the Fed is going to get their motivation or the markets are going to get a respite. But both of those things are tail results.
Once we get through non-farm payrolls, and I'm just going to get some different ticker up here on the screen, Ilya, once we get through non-farm payrolls, what's the most important thing for the market next week?
I think as we look at this next week, obviously there was an absolute flood of data this week for the markets to digest, and they've certainly responded accordingly. We've gotten a lot of volatility. We've gotten a lot of responsiveness. We're going to get a bunch of other sort of not necessarily lesser data points, but sparser data points. We're going to get revisions of S&P PMI data. The ISM services report is coming next week. We haven't even mentioned yet that the manufacturing one is expected to give us the 5th consecutive contraction in manufacturing. That comes out tomorrow. We'll see if that helps. Then we have a Bank of England monetary policy announcement next week. That's interesting for the pound, but maybe not a whole lot else. And then it's pretty much it then, which makes next week actually very interesting. I should, by the way, point out, we also have Eurozone inflation data that's coming out over the next 24 hours that might have some delayed digestion, but again, relevant for the euro, maybe not much else. And then next week, Chinese import-export data also. That's a good input into overall global growth considerations. But in general, it's a little bit sparser next week than it was this week. And I think what that gives the markets, interestingly, is some room to digest all of what they've seen. And we're seeing the price action rebel against the news flow here already, at least as far as corporate earnings are concerned. And we see the markets look at economic data that they've seen and go, you know what, we're going to see the grain of salt in this. We're not going to attempt to justify a positive view. We're going to attempt to justify a negative view. We're going to elevate one kind of a thing within the data, because the data is, as ever, open to interpretation depending on what you wish to see. And we're going to emphasize this downside risk. You see it in the growing rate cut expectations. You see it in the unwillingness to rally on earnings, et cetera, et cetera. And so when you look at all of that together, you kind of get a sense for the path of least resistance that's starting to emerge. And without the benefit of big headlines next week, or at least sparser big headlines next week, the markets may be left to their own devices for more of what happens next week. And if this is the path of least resistance that's emerging, then that's not happy news.
How seriously should we be taking the tariff deadline tonight? Because it seems like that's also ignored, not discussed today. I mean, I've been following financial media all day. People have been talking about the tariff deadline as, well, we already have things sorted with Japan, South Korea, Europe, so who cares?
And we've already apparently pushed the can down the road with China, which is another big one. And
Mexico.
And Mexico. I suppose the biggest concern here might be the situation with Canada, but ultimately Canada is not a big enough economy to really sort of spook things to the extent that something like a Japan or certainly the EU, certainly China might have, were that to be a rupture. I think very interestingly, we saw that the president made some really interesting exemptions from his copper tariffs, and copper crashed. And then the president imposed 50% tariffs on Brazil, and those markets rallied. So I think the market is maybe starting to kind of discount all of this to focus on the macro and to basically say, okay, well, yeah, there's a deadline. There's a bunch of countries that are going to get letters. Those letters will probably say that the tariffs are going to be whatever they are. 15% looks like it's emerging as the new baseline. But these are not the kind of huge economies that everybody is going to have a terrible amount of concern about impacting the global macro pie as a whole. And so it is an important deadline, and of course has tremendous potential to surprise but it doesn't seem like this is going to be a Liberation Day type shock.
Liberation Day like shock. No, I don't think it's going to be either. Although I'm the guy who said that Apple was going to be down and Amazon would be up here after earnings. So what do I know?
Yeah, but look at Apple on even a 4-hour chart, and it hasn't really gone anywhere.
Yeah, what's a 1% move between friends? So I find it very difficult to think that tariffs this time around are going to impact if they get into place. Directionally, when we're going here in April, it's more of the ratcheting up in tariff world. You know, you look at Trump funny, he gives you another tariff kind of situation.
Yeah.
And every day was we're one step closer to the edge and he's threatening us more. And then here come the tariffs and it was escalating. There's no off ramp. We're not looking at the market. You know, Wall Street's had the past 20 years. It's now Main Street's turn. We had all those cliche things.
Yeah.
And the rhetoric this time is, yeah, the tariff's going to be around 15%. I'm sure we're going to work out a deal. Don't worry about it. It's much softer directionally. So when they do go into place, it's like, yeah, they're going to go into place, but we're still going to talk. I don't know how much juice there is for that because it's still the market's condition that, well, absent materially negative economic impact or deterioration of corporate earnings, then this is something that we probably could just take in stride. So I don't know if we get the tariffs in play tomorrow and then you have a Monday market open with the NASDAQ's -2 because we couldn't solve our trade situation with, you know, Ecuador and, you know, New Guinea, for example.
Right.
Everyone else is a different story. But the encouraging signs for today's market, longer term, the dollar is still very much in the catbird seat here, Ilya. It is extending its gains versus the pound. It's extending its gains versus the euro. The Japanese yen has finally collapsed. Thank God.
No, the BOJ certainly did not help the yen overnight. Governor Ueda came out very, very dovish. Even, by the way, relative to forecast that the BOJ issued, because initially the BOJ made the announcement, they increased their inflation expectations, and